Hey everyone, how are you doing today?
Good morning, Vivek bhai.
Hey, morning Aditya, good morning. Let me see who else we have. Come on, I'm good morning, Ravi. Did you miss some of you like some previous meetings, or did I miss your name? Or maybe you've been very silent in some previous meetings. I don't recall.
No, 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 no. I was busy for 2, 3 months with my baby, small baby.
Uh,
So life is so busy. So now I'm back. Now I'm back. Even my wife was telling me, "Where is your Saturday class? You are not taking." I thought I have a small baby, so now I'm good to go back.
no
Sorry.
man, spend for a small baby. I think you have to have your priorities right. Spend time with your
Yeah, yeah. My family back are in India. They are not coming back. They are not well, so that's why busy.
okay.
Life so busy. So now it's okay. Good to see you.
Good to get you back, Ravi.
Yeah, but I can go online for all your online classes, right? I can go,
Sorry.
right? I can take you all like previous classes
Oh
online,
yeah, yeah.
right?
So our previous sessions, yeah, it's up on the website. Yeah,
Okay, okay.
yeah.
Can you send me the link again whenever you time? So I'll go.
Okay, I'll message you on Meetup, or
Uh,
maybe I can find it right away. Yeah, I've been, you know, I myself have been busy in some of the other stuff this week, so I did not have a chance to actually, I was late in uploading the recording, and then I realized on I think it was Wednesday. I'm like, gosh, I haven't uploaded the recording this year, for this week. So anyway, it is what it is. But
yeah.
feel good to be back here.
What
So
what
let
what
me.
do you have today?
So today,
Just last question. That's it.
let me just put the link to where the recordings are. Yeah, today again, I've been pretty busy this week. So today, quickly look at a macro, but I do want to talk about the impact of Claude. I also want to share an experience. Like I attended an AI meetup recently, so I do want to share what I heard from the real practitioners. But I think majority of the time, maybe I'll spend today because I didn't have a lot of time to prep for the session this week. I want to maybe use this time to go through any of the stocks that you may want me to look at. I was knee deep into, neck deep into trying to build those stuff that you've seen in Excel, just trying to create an app on that one. So, but we can go through any of the stocks that you may want me to look at because now the earnings season is coming up. So I just wanted to make sure I have my stuff ready before I start to get bombarded by earnings. Um, I just want to avoid a lot of manual work, which over the past 2 3 years I've been spending a lot of time in trying to gather data and do the just run my framework, etc. So spending a lot of time to automate that. So what things did you people have in mind? Let me ask that. Anything specific? I think I bought my first no load fund. Oh yeah. So
Yes.
which fund is that, Sam? IGV. Okay. So IGV, I also got assigned IGV, so I have a little more IGV in my portfolio. Sorry, someone was saying something.
Vivek, it
Yeah.
was because last week I was asking what stocks I should teach the guy to buy, and then everybody told me to buy funds, and so my stepfather and has been telling me 15 years to buy funds, but I don't do that.
Yeah, I mean, if you are not inclined to read through company reports or don't have time or inclination to follow individual companies, we have no business of buying individual company stocks. Plain simple. That's it. You would rather buy ETF, and then there are hundreds of choices in the ETF itself. But then you have to be careful in terms of whether you want to get a sector specific or you want to go, buy the top 500 through SPY. Um, my preferred and during that EI meetup, we also had a lady come up, and we were just talking about investing because we started to say, okay, what is everyone trying to do with these AI tools? So I told what I'm trying to, do and what I actually do for a living. And there were discussion around. So she said she's new to investing and want to talk about options. So me and there is another gentleman. We just said, okay, let's stop right here. If you're completely new to investing, don't jump into the deep end of the pool. Start small. Start with basics. Just get SPY, maybe little bit emerging markets, and little ex US. Get comfortable with investing before you start talking about, I want to look at how to make money through options and all that stuff. People get excited. I don't know. So, and that's exactly the feedback out goes, oh, it's so boring. Just if you say buy VOO, it's so boring. But here in options, we can make like 100%. We have seen people making it. What you don't see is a lot of people losing their share when trying to deal with such stuff. So, so if your friend is completely new, yeah, just buy broad-based ETF, and you'll do better than 85% of fund managers, right? So you don't have to get too cute. COHR or any memory stocks to buy. We can look at COHR. I can't tell you which stocks to buy or not because I don't know what else you have in your portfolio or what kind of investor you are. Me personally, I think I've not bought any of these memory stocks because I already have exposure to AI through some of the tech companies or the semiconductor companies. So any additional exposure that I'm getting through the AI tailwind is just through SMH. So if you look at SMH, that already includes a lot of these, companies in the whole ecosystem. So I'm not doing any memory stuff itself, but we can look at some of the memory companies if you want to and see, how great are those businesses before you buy. Pranav is saying few ETFs says dividend yield close to 100%. Is it real like BTCC, ETHD? So you have to understand what the dividend yield, when they talk about dividend yield, what that exactly mean, because a lot of that yield could be just returning capital to you. Let me give an example. Say you gave me $100, or that's too. Let's say you gave me $1,000 to I have a whatever ETF. I run an ETF. You gave me $1,000, right? And then every month I'll give you $5 back. So let's say at the end of 1 month, I'll give you $5 back. So my dividend yield is actually 60%, right? I could claim the dividend yield to be 60%. But what you also need to know is what happened to the $100 that you gave me. That might mean just only 95 remaining, or let's say only 96 because I invested somewhere. So when you're looking at these so high yield dividend, you need to understand how the dividend is being generated. Majority of the dividend might be just the capital return to the shareholders. So you should combine the yield that you're receiving and the underlying price of the instrument that you bought. And I think year 2 years ago, I mean these yield max ETFs became very popular, and so we looked at many of them and realized you would have been just better off buying an underlying, because even though the underlying has gone up 40%, 50%, these yield max ETFs on that underlying were down by double digits, right? But yeah, you get a good yield. So its idea is to look at the total return, not just the yield. You need to look at the capital appreciation plus the yield that you're getting, because and then there are tax implications differently because these are not the real dividend yield. So you need to be aware of that. Read through the prospectus of how they are generating the yield. There is no free lunch, Pranav. There is no free lunch. You just need to understand what is different in this case. Oh, John already said it comes out of the underlying price. Yeah, it comes out. So your if you look at the chart of that, that might be going down. So other question, is Thinkorswim working? I've been trying to log into Thinkorswim and it's been puking on me since morning. So, but let me go to BTCC. Okay, and let me share my screen. Is TOS working for you all? Okay. All right, BDCC. There we go. Again, you'll have to compare it with in terms of how much of the Bitcoin has fallen since last year and how much the BTCC has fallen. You got into TOS? Let me try to do it again. I was trying to get into the paper money site, so it was just puking on me. Let me try again. Oh, I didn't try the real one. Okay, looks like now it's loading. Anyway, so you got to be careful for any of these very high yield in terms of how the yield is being generated. Anytime I see some yield more than, let's say, 7-8%, I get little concerned, especially the dividend yield, because it is possible that the dividend yield is 10%, 12% just because the stock price is also down, right? Then you need to understand, am I buying into a dying business whose stock price is going down and hence the yield is going up? I have seen many such companies in which the yield is like 10%, 12%, and then suddenly you realize that some fine day they'll come and say, oh, we can't even sustain the dividend because the business has been broken. So I like the yield to be between 3%, 6%, 7%. If you're investing in some of these energy pipelines, they are a good dividend yield. You might get 8, 9%. But I think the real business is very hard for any real business to generate yield in double digits. That's my personal experience. I could be wrong. There may be some companies who basically may be returning every penny of their capital to shareholders, but then it means there are no growth opportunities left in the business. So what else? Is that it? Shall we get started? Any other things before we get into looking at the macro side? Anyone joining here for the first time? No? All usual crowd? How did you feel about the markets this week, guys? What's your commentary on the market?
Time to get cheap stocks.
Time to get cheap
Cheaper.
stocks. I would just rephrase it saying time to get good businesses, cheap stock prices. That's it. If the stock is cheap because the business is broken, rather stay away from it. But yeah, there may be stocks, and we will look into some of these SaaS companies have been broken in terms of their future expectations. But there are some companies that have already broken because their history shows that they are not growing. Don't touch that. But if some other companies have been punished, but they're still growing their businesses, their revenue, and are not seeing that the customers are fleeing yet, that may be a good opportunity to look into those stocks. Anyway, so maybe let's get going with our regular discussion. And like I said, I would rather like to spend a lot of time on looking into some individual stocks, see, and valuation, etc. Reverse DCF. Now I'm trying to make it much easier to do these things, so now we can do it in real time. Cool. All right. Any other new takers that you guys got into? Looks like none. Alrighty, let me just refresh it and let's get going, guys. All right, welcome everyone to our Saturday Dojo. Talk about investing, stocks, bonds, anything related to investing. If you have want to talk about annuities and whole life insurance policies, we can talk about that as well. In fact, I attended one session there was an online session and yeah, there was some discussions around whole life insurance policies as well. So today, like I said, I want to spend a lot of time on maybe reviewing some companies. We look at how the use of AI and how it's changing the world. Look at the macro side and maybe answer any other question that you may have on options or specific stocks. Right. Was pretty busy this week, and hence I did not have. I didn't even get to go through my regular diet of newspaper. I think last 2 weeks are just been crazy. I didn't get my walk. I didn't get to get my reading. No reading this week. No walks this week. But it is what it is. But it's fun. I'm not complaining about it. It's just that you're so excited that I just want to focus on this one and let me do it, because next week I'll be traveling for 3-4 days. So I just wanted to get a lot of work done this week. But this is the situation right now. So let's dive into today's discussion. Let's start with macro and then we'll get into individual stocks. Before that, we have a tax deadline coming up. You guys done with your taxes? You don't have much time. It's already 11th. 4 more days to go. Anyone got tax surprises? First of all, you guys done with the taxes? Any surprises, tax surprises you had? I was talking to someone, we play together, and in 2025, that person, because the market was great and he was doing those, trying to play for the lottery tickets and all that stuff. So he said in 2025, I made some decent money. It was great to see the account going into, suddenly like almost doubling it. And, but then he said in 2026, the account is way down. But then now he figured out that he owns 150K in taxes, which hurts. Right? And this is an important part which I think many of us miss out. In fact, I was not focusing on taxes until I say 3 or 4 years ago, where it started looking at the tax implications of any of the trading or investing you do, right? And especially if you're doing swing trading, day trading, and all that stuff. So you might be hit with a lot of a tax liability if you're not, keeping good track of it, and if you're not actually setting aside the capital to pay the taxes. So the problem with now that gentleman and that's what he was sharing, is that now I'm in a soup because I owe 150K in taxes, but my portfolio is down, that if I have to actually generate the cash, I have to sell a lot of the stuff at loss. So 2025 it was great, made a lot of money in paper through the trading. It's like a swing trading and day trading, but now ended up in a situation where did not set aside the capital to pay the taxes and not trying to figure out how to even pay that. So don't be that. Keep an eye on your realized gains, or with whatever brokerage firm that you use, and make sure that you are aware of it and not get surprised at the end of a year. How do I manage mine? I've been very focused. I look at both, Schwab, and mostly around on the Schwab side. It shows you how much of a realized gain that you have, right? And then I try to actively do tax loss harvesting. So I was looking at tax, and this, like, my wife keeps complaining, saying, "You're not making any income." I'm like, yeah, sure. I don't want to make any income, right? I want to get a cash flow, but I don't want to make any income because I have to pay taxes to government then. So even this year, so I did a lot of tax loss harvesting in 2022. 20 this year also there is zero capital gains. Last year also there was zero capital gains. But I think in 2026 probably I have to show capital gains or income, because I don't think I have a lot of losses to offset, right? Maybe I'll try to find out. I'll try to figure out, maybe do some box trade and spend on some interest, etc. But whole idea is you become consciously track and keep an account of, hey, how much is your realized gains, because the IRS will tax you on the realized gains unless you have a the trader status. I'm just talking as an individual. Your tax is based on how much is your realized gain. So if your realized gains, look for some of the stocks that are maybe down 60, 70, 80%, right? And you don't see anything coming up in like next 30 days, maybe sell those and reduce your tax liability. And if you really want to hold it for long, because maybe the business will turn around in another 4 or 5 years, wait for the wash sale period, which is 31 days, and then buy it back. At least for this year, you have reduced your tax liability. Right? Just being conscious of looking at your realized gains, just get into that wheel. You don't have to wait for. I think question from Santosh, do you have LLC or a personal? I don't have any LLC. Right? It's just like on my individual, like, personal DIY account. It's in my name, and but ever since I became more conscious around, I don't want to pay taxes, I started looking at these things, right? And the idea is that if you don't pay taxes, that money continues to stay invested and continues to keep growing. At some point of a time, you pass it on to heirs at a step up cost basis. Okay, then I don't have to pay anything to the government, right? Won't happen all the way till there, but avoid taxes as long as I could. That's my intent. So it will also avoid a lot of surprises that you might have otherwise at the end of a year, because if it shows up in terms of how much your realized gains are, make sure you keep that capital aside to pay for those taxes. I don't know, anyone else wants to share your feedback, because I personally started looking at consciously over the last 3-4 years, right? Along with the job, never had a time to focus on these things, right? Barely you could spend time on investing and trading along with the job.
This is Satish here.
Yeah.
When do you start looking at harvesting?
So harvesting, I start to consciously look at around mid of Q3, after mid of Q3. Right.
Okay.
Because then I need some time period to start harvesting my losses, right? And so I'll start looking at around mid of Q3 and say, okay, guys, how much of the gains it shows, and now where I can basically reduce it. And then again, you need to be aware of the was sale period. So minimum 30 days you need if you need to buy it back, etc. Right? So, but I look at around mid of Q3. So yeah, but just being conscious of it will force you to take some steps and okay, I know what's coming up. At least don't get surprised. Right? Aditya Singh, is it true that you can only carry forward capital losses up to 3K? Yes. So if I look at my tax returns, it says capital gains is negative 3,000, right? So you can only carry forward. Uh, uh, no, you can carry forward as much as you can, but you can only offset, right? So 3,000 additional against your personal income. And so let's say if I had $10,000 of losses, and then I have my, I can or on the capital income and capital losses, I can offset. Let's say I had previous carry forward of $10,000. This year, my capital gains were 3,000. Right, so I can completely wipe out my capital gains, and then I can additionally reduce my taxable income by 3,000 on my income tax, and then the remaining. So I got done 3, 3, 6. Remaining 4 will be available for me for the next year. So that's all. But you can offset all your capital gains against the capital losses, but your non-capital gains like your WT income, etc., or that you can only offset 3,000 every year. Ashwin says, I use Claude to summarize taxable income, blah, blah, blah. 15 minutes generated all the numbers. I have seen so many posts on X around how folks are using Claude. And not just Claude, even some, even on Chat GPT, etc. They do some good job. But specifically around Claude, someone had talked about that they own a business, and he said, I think I should not pay like whatever you mentioned, some $2,500 to CPA. And it says, I gave my previous year tax returns, this one, and figured a lot of stuff out, and to where I can save and where I was not taking advantage of the stuff that I could have. And then he posted a screenshots of, he asked this question to CPA and CPA agreed. Then he was like, why should I pay $2,500 to CPA? And when Claude can figure this out and tell me all these issues, with my CPA hasn't told me over years. I think some part of a time we may have to look at that. Now I understand the market is panicking on Intuit. I mean, not just Intuit, there are a lot of others. So we look at some of the list of those companies wherein they have been badly beaten because of Claude. And I think largely the fear is around Claude. I don't see people talking about the other LLMs in the same vein as Claude. Right? I use both Google as well as Claude, but when it comes to searching and research, I think Google, I found it useful. I haven't used Claude for, let's say, tax purpose or any of that stuff, but when it comes to the technical work, Claude is the best. I mean, hands down, it wins hands down. And that was my experience when I was talking to some of the AI practitioners in the meetup. And there was one gentleman who was referring to. Now we'll come back to macro. But there's one gentleman who was saying he manages basically some legacy software in his company. He's like more than 1 million lines of code. He's been waiting for last 10 years thinking to refactor that code. Never had the courage to even touch that code, but say after using Claude, they got it done over a weekend, basically spun up different agents and have Claude go and fix it, retest it. And then he said, I did have to monitor in terms of all the changes and make sure that because he understands the business logic, make sure that there is no negative implications. But Claude figured out how to refactor it. So, and he's like, he started with a $20 subscription. Now he says he's on the max one. And that was the feeling I got from many of the, you know, the software people, is you just can't live without it. Living without this tool, Claude would be like, I'm trying to run my accounting firm without having computer with me. Right? And so I also asked about how about the Codex. So it's or Gemini. No one talks about Copilot. Anyone here using Copilot for the tech work?
Yeah, I use Copilot.
For coding stuff.
Yeah, for coding stuff.
How is your experience? Because I couldn't find anyone. I spoke to like 4 or 5 people from software engineering, like engineering managers and software developers themselves. Nobody used Copilot. So how is your experience on that?
So by default, VS Code comes with Copilot, Git
Yeah.
Copilot, right? So I wonder how these other people are actually using this Claude. That means they are going out from their enterprise.
Like no, in the Copilot Visual Code, you have the agent chat, and it is basically GitHub.
No, I think these are two different Copilots. One you are talking about is GitHub Copilot, and what I think Vivek is talking about is Microsoft Copilot.
Oh, Microsoft Copilot is only for your Microsoft.
Correct me if I'm wrong, but yeah.
No, I don't use the enterprise Copilot in Microsoft. That's a different beast altogether.
So I downloaded VS Code like after almost 20 plus years. I got back into, with the help of Claude, in a mode of developing something. So I downloaded VS Code. It walked me through all the installations and Git install and whatnot. And there is a window on the right side where you can chat with the Copilot. I never used it. And when I was talking to some of the folks, they said so Copilot, they said no one uses for the development work. Codex, I said, how about the Codex stuff? So Codex we use when we know that our token gonna get consumed in Claude, and we want to save our token. So we'll go and do some of the initial groundwork on Codex, and then feed all that input back to Claude, saying to do the real work. And that's the feeling. I actually spoke to 4 or 5 people. Only time they will go out of Claude to do the coding work. I'm not talking about any of the research. Someone was talking about the Manus AI is very good in integrating a lot of stuff. But only when it talks about the software development, coding work, folks said we stick to Claude. It's miles ahead of any other tools. We go out to the other tools when we have to save tokens, because they are on $20 plan or whatnot, right? So, but that's a feeling. That's a feeling I got.
So GitHub Copilot is just the launch point, okay, and it gives you options to pick agent, and right there you can actually pick Claude Sonnet and Claude blah blah.
Yeah,
and even
that's correct.
GPT and so on.
Okay, so then maybe folks probably end up picking Sonnet or Opus.
Yeah, I pick up Claude Sonnet. So yeah, so it's over there is GitHub only.
You need a GitHub account, and then if you get the subscription, you choose the cloud agent, and then it give you a variety of agent, including the cloud. So
in the last 1 year, Microsoft stock is down so much, right? Why, you wonder? So a year ago, GitHub Copilot was like the big buzz for doing some, and also the cloud was the big thing. And now these things are in the background. Honestly, Microsoft Corporation has lost its lead in, I would say, machine learning AI stuff. Basically.
Yeah. Again, as an investor and as a practitioner, I just wanted to see what the practitioners are doing.
What I meant was like they bought GitHub, and I thought like a year ago they would leverage that darn GitHub for doing some Copilot stuff, but that's all gone now.
No, GitHub is only a Git repository software and collaboration
But that's how they get. So when the original founder or idea came from GitHub people, that they scrape that whole thing with LLM and provide you, like
Yeah, the
prompt.
LLM come from OpenAI because Microsoft invest money on that. So they put the OpenAI agent in Copilot.
Also, the recent thing I read about is like Microsoft and business like 365 with the Microsoft Copilot fails at doing basic tasks compared with Microsoft 365 with the cloud extension. So a lot of people now use the cloud extensions inside of MS Office to do a lot of the task, which is kind of the
Yeah.
cloud Copilot co-work thing. Yeah, because the
Yeah.
A branding of Copilot. There's a Copilot
So if I look at a Microsoft, so I just pulled in Microsoft stock, right? So I mean, from it's a great start looking at 10, 15 years of average, right? Great profit margins, like 30, mid 30s profit margins, great operating margins. Of course, over the last few years, they've been investing heavily in capex. So you see in the recent averages for last 3 or 5 years, the capex is higher than where I would want it to be. 18, 20% of their revenue, which is higher, but good free cash flow, etc. Everything. Now the question that really is cash. Can they sustain this in future, right? So if I look at it from valuation perspective, right now market is pricing in free cash flow growth of 14%, right? Which, if I look at our last 5 years free cash flow growth, CAGR is only close to 10%. Right? So from that perspective, let's say if I say they are not able to grow free cash flow, and this is like again based purely on free cash flow, right? No multiple expansions. And I say they still stick to the 5-year CAGR because they will continue to have to invest. As an investor, I may be surprised if the free cash flow doesn't go down because it will need a lot of investments in data centers or whatnot, right? We've heard of stories of $700 billion of investments, right? But I give it benefit of doubt and keep it at 10% free cash flow growth for next 10 years. You're looking at Microsoft seems to be now expensive. Or maybe reduce the discount rate to 8%, which is generally, and growth rate, let's say give them a terminal growth rate of 4%. They'll grow higher than GDP, which generally you should not do it because then at some point of time it will become the overall, it will be bigger than the world, right? So still at 8% discount rate, it's not cheap from what's being implied in terms of the expected free cash flow growth.
So what changed in the last 6 months for Microsoft's numbers that made this
No, I'm just looking at their last 4 quarters of free cash flow is $77 billion.
So nothing changed that in the numbers here, the discount rate and
So let me bring that. So I'm looking at in the current share price of 370,
Mhm.
right?
Then why was it 600?
No, that's a pricing. Value and pricing are two different things. You may be willing to pay 400 because you might be thinking, oh, maybe it will grow.
Okay.
And some point of time, people don't even know whether we'll just pay it because everyone else is ready to pay. It's a multiple expansion.
So 6 months ago, the valuation was almost the same. You're saying 370 or whatever.
From a valuation perspective, yeah. So value doesn't change much in the businesses. It's the pricing which changes on daily basis. Businesses don't change, on day-to-day basis, but the price changes every day. Every second, the price changes.
If expected growth rate of the revenues or earnings changes in 3 months for Ciena, then obviously its value will also change.
Then yes. So let me go and look at and this is what I have to maybe yet implement is in terms of expected growth rate, Microsoft, we are looking at, let's say, they don't have a free cash flow growth rate. So they're looking at a revenue growth rate of 15, etc. And earnings growth rate of 17%, 16%. And let's assume that all your earnings, it gets to the free cash flow that we can look at going back to see how much of a free cash flow conversion ratio, 70-80%. So 80% of your earnings become free cash flow. And if your earnings are growing at 17%, run a math, let's do, like, oops, that was 8%. Because it's established company, let's do 15% expected growth rate. Then
Yeah,
you're
my
looking at $550 as a stock price. But
yeah,
now
my
15% free cash flow growth is almost 75% higher than the free cash flow growth for the last 5 years. So do you think Microsoft will have more cash available in future than they had in last 5 years growth rate? I don't think so, because I think in future they have to invest a lot of cash in building these data centers.
so the earnings growth reported last was 59%, 59.8, right? And my spreadsheet shows that for Microsoft, implied expected EPS growth rate is 18%. You're right about that.
Yeah, EPS growth rate is 18%. So I'm looking at a where's earnings?
Based on forward PE.
Yeah, so revenue has been growing 5-year CAGR at 13%, 15%. Whereas the net income has been growing at net income has been growing at 5-year CAGR of 20%.
Yeah, year over year, 9.5. See, year over year is net income growing at 50.
Yeah, year over 1 year. Yeah, that's year over year is for 1 year it's 60%, right? But I don't want to look at only 1 year. I want to go back and maybe look at 3 years, 30%. And 30%, if you're looking at 70% of their earnings basically become cash flow, you can run. So whole idea is I was just trying to look at. I mean, Microsoft looks cheap. If you look at a stock price perspective, it's down 23, 24%. But then when I try to look at some numbers, I'm like, is it really cheap? Because I have a short put spread on Microsoft, which is in the money. Maybe I'll buy a little bit, and probably that's would be right. Especially when I go and talk to people, and I don't see people talking about Microsoft in terms of the how good it is, their AI tools are. But most of the time, it's an enterprise company. It will figure it out. Microsoft has gone through many, over last 40 years of their existence, they've gone through these changes multiple times. It will figure it out. So that is the promise which I see a lot of Wall Street analysts also talking about. But when I talk to practitioners of AI tool, nobody talks about Copilot.
Yeah, it'll be a cash cow, like, from 99 to 2000. For 10 plus years, the stock goes into like a complete sideways move. Nothing moves.
Yeah. So I say Samsung Copilot is juvenile. Anyway, I use Claude in Visual Studio Code. I have to check. So I use Claude outside of it, but again, there's a lot of stuff to learn. But as now I understand okay, we already looked at it. And Microsoft lose money on their OpenAI investment. So that is also a concern, right? Again, now OpenAI, nobody talks about OpenAI, and they are panicking anyway. OpenAI is now panicking because looks like the talk of the town is now Claude. Well, somebody had put a comment around Claude, Mythos. So we will look at that. Anyway, there's a lot of stuff on this AI. I think we can talk for hours. But let's get back to look at a macro. And unless there are questions on any other stock. So there was a question on Microsoft. That's why I pulled it up and say, okay, let's look at Microsoft. Rajesh said many software developers and have done this too. Use Codex and Cloud to ping pong. Yeah. Can we compare NBIS versus CoreWeave versus PL? What is PL? So let's bring up NBIS. I don't think I have yet, so I'll have to pull in the data. So we'll look at NBIS. CoreWeave stock did great this week because they announced deals with was it Amazon? Of course, they announced deal with Anthropic, but I thought there was one more deal that CoreWeave had announced. There were, and I think the stock has done great. It was up on last day around 10-12%. But still way down from its all-time high of around 170. Let me do it one day. Yeah, that gives a better picture. Wow, its all-time high was around last year in June, 175. So still lot to catch up, but this has been a good week for CoreWeave because they announced some deals with Anthropic and I think one another customer. Again, for me, the reason I'm not an investor in CoreWeave because great, you got a revenue, but is this revenue is margin accrual to it or is going to hurt your margins? I'm not aware of that deal, but overall, if you look into this companies and its financial performance, it's not a great business from a revenue perspective. So from a margins perspective, right? So I'm looking at this as a Nebius. Right?
So yesterday I heard this CoreWeave CEO on the TV saying that they could be like net income profitable instantly, but they are trying to gather market share and basically grow fast.
Yeah.
So I think CoreWeave actually, I'm feeling now after several months, it's probably a good stock to buy, even if it's not earning. I mean, income EPS is negative. And
Oh yeah, I mean, I'm not looking at right now. The question is the data center business, the business of data center in a larger grand scheme of things, could it ever be a higher margin business or not?
No,
Not
so
like 1 year, 2 year, 5 year, right? In longer, is it going to be a higher margin business or not?
right. So
question.
anytime when superhighway is being laid, lots and lots of contenders will be there. Like railroads were being laid, or internet highway was being laid from 95 to 2000, and everybody will scramble to spend, and then a couple of winners will emerge, or people who are, companies who will be in the lead, and those will capture the gains. But basically, in the end steady state, it may still turn out that it'll be a kind of like a very mildly profitable business, like AT&T service provider,
Yeah.
or Verizon, etc. Right? There were hundreds of ISPs also who faded away. So I think basically you have to ride the wave of CoreWeave and all while the going is good.
That's fine. Yeah, you want to take a bet on that one? Great, because everyone is.
Otherwise, you'll only buy undervalued stocks like Buffett style, and there'll be hardly any.
It's a different style. I'm ready to buy growth stocks, but I can't convince myself that building data centers in the long term is
I agree.
actually a great profitable business.
I agree with you. That's true.
So, but if let's say if instead of this, if it was, let's say, another company, maybe an e-commerce company which has to invest a lot in logistic, warehousing capability and all that stuff. So it may not be profitable for next 5 years, but I can at least visualize saying once you have this initial infra, you can start to make great, good margins. I don't know. Somehow I can't visualize. And right now I'm looking at the CoreWeave. I think they're in public market only for 3 years. It's one of pathetic numbers. But anyway, it's only in 3 years, so I can ignore these numbers, right? Any valuation on CoreWeave just doesn't make any sense because they are not even generating any free cash flow. So there is no point in talking about any valuation. So it's based on in future they will continue to grow. They will be the leading data center capacity provider and will somehow figure out how to make it a high margin business. Then I'll give it to them. But I don't think even in 2020 we had a lot of companies, right? There is one big data center company, what, Equinix? Does someone remember the ticker?
Equinix.
Yeah,
EQNX.
NX.
Oh, no. Sorry. Equinix. Equinox is the health club.
EQIX.
Yeah.
Okay, I don't want to look at the chart. This company was very popular in um
It is a
2020.
very stable, financially profitable company now. You're absolutely right. Like it has a big history, right? 20 years, and it can, yeah. So yeah, these are the winners of the last internet boom, which ended in 2001, too.
Yeah. More or less is rule of 40 for CoreWeave. The problem with CoreWeave is valuing GPs into futures like H100s into 5 years. I mean, also Jensen Wong has something to say about it, right? It says even the old they have their Ampere chips, right? Now are being valued more than what they're sold earlier because there is so much demand of those chips. Right? So having these companies extend the life of chip or they're not depreciated at a pace at which Wall Street would want it. I think for right now it's okay because they can continue to use these chips for 6, 7, 10 years. You really don't have to write them off in 4 years. So I'm looking at this what Equinix, right? It's a decent stable business. It's not bad business.
Very stable, very
It's
profitable.
yeah, I'm looking at stable business. Their dividend yield is like 2%. But this is right. The return on invested capital not that much. You can find much better businesses. But if you want stability, yeah, it's a good business. Not great that you would pay up what I think some of folks paid up for Equinix in 2021 and all that stuff. Right? It's a heavy capital intensive business. So this is what's crazy stuff. Oh, oh my God. They have to spend 97%, I'm looking at what 3-year average, of operating cash flow into the CapEx.
It's
Then,
exactly like a service provider concept, right? Which are AT&T,
yeah.
Verizon. There it was days when 100 service providers there, like Exo Communications, Excite at Home.
So I think, yeah. So
That's
I'm
what
not
we
too
should be
keen
able to.
on CoreWeaves or the Nebius of the world. I don't know which one will survive because all of them are fighting in the battle, which itself is, first of all, that market itself is not a high margin market. It'll become a utility market, and right now there are a lot of players trying to fight in that one. I will watch from the sideline. There will be companies which market will be willing to give high price, even though they may not deserve, because hey, everyone wants a piece of action. So yeah, let others jump into that arena and play their game. I'll watch them from sidelines. I don't
Nebius
think
has
it's
been advertising heavily in the San Jose area. If on the buses, on the Caltrain, you'll see big signs of Nebius.
so that is still maybe so if they're buying if they're basically buying a football arena, maybe that's the time to sell. That's the top. We have seen many companies, that's a telling signal when they get their name on football stadiums. NBS is Indra says, yeah, Nebius same like Huawei. Yeah. I mean, I haven't looked at in terms of the debt, etc. But I won't be surprised if they have a high debt amount. But many of these infrastructure companies, even AT&T, they'll have a high debt load because they have a predictable source of revenue, and
Exactly.
having that predictable source of revenue allows them to basically take on high debt and hence increase the return on equity for their investors. I mean, that's a playbook from John Malone. He's been doing it since 1980s.
Right. So for people who want to buy bonds, these companies are perfect. Like
Yeah,
Equinix,
exactly. Yeah.
AT&T, or if Corvi were to offer a bond, maybe you should buy Vivek. You should buy their bond because you don't want the growth aspect, but you love the predictable cash flow.
Oh, what I'll do, I don't know if this company will continue or if it becomes bankrupt, what I'll do with their assets. So I'll stay on the sideline. Either Okay, all right. Getting back to it. So this week we had, I think the markets did good because we thought we are gonna get a ceasefire, and but it's like a wishy-washy ceasefire, very weak ceasefire. The market was up like 2-3% when the ceasefire was announced, and then the next day itself, I think they started negotiating and debating about the terms of ceasefire. So anyway, so the net result is, I think SPY is back to where it started the year, even though we might feel like markets have been crazy this year. Not really, it's back to where it started. So almost nothing burger when it comes to the market for this year. Oil is up. I mean, the oil was down 15% on the news of the ceasefire, but I think then later on it inched back up. Anyone investors in crude oil? Where are some of those folks who are trading futures in crude oils?
It's good I got out of my Oxy.
Oxy. I've never looked at Oxy.
Because Warren Buffett advised me 2 years ago. I sat on it for 2 years, dead money. Finally got out.
Oxy. What you got in because Warren Buffett got into it?
Yeah, 2 years ago, 3 years ago, I didn't analyze. I thought, okay, Warren Buffett is buying it big, so something good.
That's a. But he's Warren Buffett. He can make changes in it. You can't make changes in Oxy company. You're a recipient of whatever the management does. Ray says, I bought WTI oil futures. Okay. Yeah, I don't have any. For me, I had an XLE which got called away. I think at 55 or something. I don't know where XLE is, but I'm not selling puts on XLE just yet. I still own XLE. Once, I think 20% got called away. I still own. It's back to 56.
Yeah, I think any betting on oil should be stopped because the decision has been made with respect to Iran, pretty much.
Yeah.
Everything else will be minor.
No, so I will wait to fill my XLE tank because it got called away. I think maybe at 55 of it. I'd have to go back and check, and yeah, it'll return back, and then I'll start doing the short put to refill the tank. I still own XLE, but some portion got called away in this run up to it. So Oxy Petroleum. Oh, wow, good dividend yield, man. More than 3%, but again, pretty stable. Growth investors won't like it, but it's a stable. Oh my God, what happened in last 2 years? EPS have been down. Revenue, this is what concerns me. Revenue has been growing down for Oxy. So, not that the revenue it was never a revenue growth story because the revenue growth has been like close to 5%, but over the last 2-3 years, the revenue has been going down. Again, I don't track this sector, so I don't know what's specific to Oxy happening here, but I don't want to put in money in a business where the revenue is going down because then you can only cut cost up to a certain level. Right? You can cut up to the bones, not beyond that. So I do want to see companies operating in an area where they can grow their revenues. But yeah, it's a good cash flow. Look at a free cash flow yield. It generates cash. And they're basically, having all that, whatever operating cash is coming back into the free cash flow. From that perspective, looks good. But yeah, no revenue growth is negative. I'm not interested in that one. Anyway, so other number is the inflation start to go up. Shouldn't be surprised. We had PCE number. If you look at last 3 months of an annualized number, right, is now close to 4%. And goods inflation is close to now 5%. So goods inflation is coming from the tariffs. The costs are now being passed on to consumers. So you see that starts to inch up now close to 5%. But CPI number that came on for March, we were still up 0.9% over the month. This is the largest increase in 4 years. And all this Middle East war going on, you can blame it on it because the gas prices is up 21%. There has been only 8 months in past 40 years in which the inflation has risen this much. And 5 of those 8 were after COVID pandemic, right? And this is the one. So you got a month over month close to 1%, like 0.9%. So all the promises of if you hear administration or DJT, there's no inflation. The numbers show something different. So we are hitting close to 1.9% month over month inflation. That's not gonna be good. And it only good news in this CPI number was the previously we had a shelter or housing price, the sector contributing a lot to higher inflation. That is now seems to have come down. Shelter inflation is coming down. It means, but that used to be very sticky, that once we get through the current issues in with Iran, the overall inflation should come down because some of the stickier parts are already trending downwards. It's just that this oil and the gas prices, and which then percolate. First is the basic energy prices go high. You feel the pain when you go to the pump, and then you feel the second degree pain when you go to buy the stuff because a lot of everything price goes higher because they all consume energy or they need to be transported and they consume diesel, which prices are also going higher, right? So, but hopefully ceasefire is stays beyond we have a deadline of ceasefire in April 21st. If we get a peace deal after that and the Strait of Hormuz is open and we start to see the supply of oil normalizing it, then maybe inflation will trickle down. We will see later, but right now the inflation is not that great. The numbers don't look good. Market has started to pricing in that we will get a peace deal. And so if you look at this chart, we are back where the market was close to when we had this Iran conflict, right? So here you're looking at S&P 500, not quite there yet, but almost there. This is developed markets still has to catch up, and this is your Russell 2000. Russell 2000 is, yeah, I think almost we reached back to the level where we were before this conflict started, right? So market has started to price in, and I think Rajiv said that, hey, we know the end result, that both the parties have come onto the table. Now we need to basically negotiate the terms of this peace deal. What's included, what's not included? Is it Lebanon included, not included? Will Israel continue to bomb Hezbollah and whatnot? I don't want to get into the politics and the details of it, but we'll get through it. I think market is already pricing it. We'll get through it, and market is always forward looking. So that's and but looking at an inflation number, 0 rate cuts this year, at least data as of today morning, right? What we're talking about December is only 25% probability that we may get 25 basis point rate cut. If inflation number, this is largely because of the inflation numbers, right? And if we start to see that the inflation number come down, these probabilities may change. At the start of a year, we were looking at what, two rate cuts, or I think at some point of time it was like 3 rate cuts. So, and now we are looking at maybe none, right? So if your thesis was based on rate cuts and hence the some of those growth companies, that was your thesis, you may want to relook at your thesis. Rest, there are a few other folks on the oil trade. XOM, ExxonMobil, and Chevron are good for dividends. Yeah, so I think all these energy companies are good in terms of dividend. So, few years, not few years, maybe 2 years ago, till 2 years ago, I used to hold AMLP in my retirement account, and that was like 6, 7, 8% dividend. It's an ETF, Allianz ETF. Basically, they have these pipeline and oil services companies under it, but then I wanted to consolidate everything into one ETF to reduce the number of tickers that I have to worry about. I moved everything into XLE. But yeah, all these, I think the oil companies, they're still profitable, they still generate cash, just that they have not been investing into growing their capacity, because like the rest of the world is, we're gonna move away from fossil fuel, so they'll just return that capital in form of a dividend. So a lot of these companies are good dividend paying companies. Vishal bought Oxy at $8 in 2020. Where is Oxy right now? 57. If you held it till then, from 8 till 57, that's been a hell of a ride. That was like 2020 was a COVID. Yeah, that was a great time to buy any of these oil companies. I think I bought some AMLP at that point of a time, but then sold off after 2022, or maybe I think I sold AMLP in 2023 or 4, whatever.
I think I sold it at 64. 64, half the position, record the profits at that time, and anything is now on the house is running.
Yep. And I mean, I do want to have energy, but then again, I wanted to consolidate the number of tickers, so I now moved everything into XLE. I just don't want to have these individual companies in portfolio. Nothing against the companies, it's just that I don't have a time to follow so many companies at an individual level. Okay, all right. I got some update from someone who's trying to share some stuff here, guys. Please do not engage in those activities. I'll have to move you out. If you want to, again, I don't sell anything in this meeting. I just want to keep this meeting only for our learning purposes. If you want to shell something out, figure out your own meeting. Okay. Thanks for updating me. What else? With all this geopolitical stuff, and now we know at some point of time we will reach a deal. May not be next month, may not be 2 months later, maybe 6 months later. So right now, and again, I don't track the futures price of crude, but someone who are. But what I did here is that I think the futures, let's say November, December, the pricing of the crude is low. Basically, it's in a backwardation, and the more in near prices are higher. But I think market is pricing in that things will settle down. So it's time to focus back on earnings and the growth. Just want to remind you that whatever in the long run, the stock price will follow the earnings and basically the growth in the earnings, right? Or there are a lot of other studies also which tells you earnings or return on your investments. Yes, in some cases we do have a multiple expansions, but in the long term, it's all about earning power of the business, right? So now the focus will be back to what companies are reporting in terms of their earnings. More importantly, I think in terms of their guidance. at a very high level, if you look at the guidance, not the guidance, but like estimates coming from World Bank and IMF and some of these, bigger agencies, they are hinting that at a world level, the growth will slow down because of this oil shock that the world has to go through it, right? So I won't be surprised if some of the company CEOs take that as a cue or hint and say, hey, maybe, again, not all sectors. I'm assuming energy companies probably will report good earnings because the prices have gone through roof. But we are talking about Q1, right? So this happened only after March. So don't know what they're gonna report. But I won't be surprised if some of the other sector companies could report slower growth because hey, consumer is facing higher inflation. They're not gonna spend that amount of money on non-essential goods, and then they may see some slowness. Again, we'll wait to see what companies and the CEOs report. As of today, I don't think Wall Street analysts have brought down their estimates of earnings growth for 2026 because we haven't heard from CEOs just yet. So as of today, the estimate is still, I think, between 12 to 14% earnings growth for 2026. And if that's the case, yeah, then we should see market responding to it. Right? Market is right now where it was in 2025, at the
I
end
have
of 2025.
I heard that the estimates for S&P 500 have been revised upwards for 2027 recently. I
For
haven't,
2027.
yeah. Okay, if there were some estimates 3 months ago for calendar year 26 and 27, today they have been increased as of 3 months compared to 3 months
Okay,
ago.
okay.
So
Yeah.
basically, what gives? What's going on here?
So I think the tech growth, so I was reading like energy and the tech, that those earnings growth have been increased.
Right. And what is the underlying economic reason they are giving for that?
I mean, I've not gone through the report. I have not looked at it. I just saw that at an overall level, these two sectors, the growth, the expected growth rate
Mhm.
in has been increasing. Again, I think when you talk of a tech, the majority could be they still see that the hyperscalers will continue to grow their revenue, right? I don't think they're talking about. I don't know if was it about the growth or revenue growth or about the earnings growth.
Earnings. So, yeah, so what I'm saying to myself is like the momentum in the US economy continues. It doesn't seem to stop.
And maybe inflation has some part to play. They'll basically increase the price because the inflation is also going up. So maybe we should look at net of inflation. How much are they growing? Uh, Consumer sentiment is at the lowest recording since 1961. Yeah, consumer is saying I'm not gonna spend on non-essential goods because all my money is going to the pump. Even Costco. I failed. I was at Costco Wednesday or Thursday, and then I filled it. It's like 5.89, something like that, and that's at Costco. If you go outside, if I go to Chevron and all that stuff, those are Chevron and Shells of the world. They're all like 6.39 and then plus. So yeah, we will feel the pinch of these higher energy prices. Uh, what's the chart showing exactly? So this chart basically shows you since 1990, right? Your S&P price has annualized grown at 9% rate. And out of that 9%, 8% growth is coming from the growth in earnings. So, and this is also shows you from a different decades. So 2010 to 2020, the multiple had a higher contribution. Last 5 years is mostly the earnings story. Longer period of a time, it's a earnings growth that drives the stock market returns or S&P 500 return. Short duration, it could be the multiple growth because here because at the end of the day, it's a story. in short duration, is generally is the story that drives it. In long duration, it will be the numbers that
How
start
do
to make
you
sense.
how do you
Growth
get this
numbers.
Goldman Sachs investment research? Where do you get it from?
Oh, this is an old one. This is like I've shown this chart in some of the previous meeting also.
Hmm.
But today I brought this back up because now we are getting back into earnings season.
So it's available publicly. I can get it on
I
LinkedIn.
think I can't recall it. Maybe a month ago.
Okay.
I took it. This one is available publicly. This is from Carson group, where again they were talking. They're looking at, but they're only looking at 2020 to 20 last 5 years worth of data in terms of what is driving. So only 1/4 is driven by the multiple growth, right? Everything else is dividends, revenue growth, margin growth. Again, just a reminder that on a long-term basis, if you're looking at the business growth is what determines the stock price growth. Right? So let's talk about earnings. We're getting back into earnings growth. First week, we will always start with the financials. So we got a Goldman Sachs on Monday, First Bank, JP Morgan, BlackRock, so on and so forth. First week, generally financials heavy. Plus, we do get 3 companies that generally I look at. I mean, not that I don't own Netflix, so I don't like really track Netflix, but I keep it on my back of my mind that Netflix is there. I will look at it in terms of what they've reported. But 2 other companies that I'm very much interested in is ASML and TSM. These are 2 very important companies for the rest of the world and for our AI growth story. So let's look at ASML and TSM as a company. So let me bring up ASML. And this is what I like about ASML as a business. I know the stock, I mean, has been at multiple places. Right now, the stock has done great. But from a business perspective, it's still a great business to invest in. Right? No, it's not a big buyback or dividend, but what I'm focused more on is their margin story, right? More green boxes in this means I'm more inclined to dig deeper into the stock and potentially own it. And I like that about ASML. Good free cash flow generating company, decent margin company. Look at a return on invested capital is like close to 30%. Net profit margin is like 28%, like close to 30% net profit margin. Not as high as not as like say software company margins, but this is a hardware company. Right? For those who don't know ASML basically produces the machines that enable chip fabricators to actually make chips. Right? And they have a monopoly on EUV extreme ultraviolet lithography machines. It's a Netherlands-based company. And that is why maybe if we heard in the news around why Trump is, telling Netherlands to not allow ASML, why it's getting impacted is because Trump is trying to make sure that the Netherlands doesn't allow ASML to export its EUV machines to China, right? So, but yeah, I still like this business. It's not available right now. It's not available at I mean, it is not cheap from a PE perspective, right? But it is trading at an expensive valuation, but it's a good business to own. So something, if you don't own it, maybe keep an eye on it to see if you can, if and when it falls, you want to add to your position. So let's run it through our valuation stuff. Currently, we are implying 20% growth in free cash flow. Over the last 5 year historically, they have done 25% free cash flow growth, right? If I do it on keep it at 25 because hopefully this China issue get resolved and if they're allowed to sell it in China, that will increase their margins as well as their revenue. Few years ago, China was the biggest consumer of their EUV machines, right? Which means they continue to grow their free cash flow over 25%, or maybe give it maybe 20%. 20%, then it is fairly valued. Right? But if you think it can grow it higher than 20%, then there may be, from a valuation perspective, currently it is free. I've had a 20% growth. It's not available at a cheap price, a cheap valuation.
Can you summarize the valuation model? You're using a two-stage discounted cash flow?
No, this is a reverse discounted cash flow. So I don't have to predict in terms of what company is going to do. All I'm trying to look at is, like Howard Marks says, right? You should know where you are. You may not be able to predict where the market will go, but you should know where the market is. All I'm trying to do here is, given the current stock price or 1478, market is implying that it's going to grow its free cash flow by 20.5% for next 10 years.
Based on some linear growth, like I'm used to seeing a DCF model with lines, right? So
this is the reverse DCF model.
Reverse, you're just giving a terminal value and backing out the growth, but still there must be a linear growth implied in this thing you're showing called implied growth 20%. Is that a linear thing or is it a two-stage thing?
No, it's a linear growth implied. Like every year, if they continue to grow that free cash flow for 20.5%, then you apply the terminal growth at 3%. Like for 10 years, you grow at 20.4.
Okay, so it's a two-stage.
And then you apply a terminal growth of 3%. Then you basically do a summation of their overall, like whatever the DCF does, right? Your cash flow over the life of the company, and then you discount it back at 10%. You end up.
How many years is it to the terminal value?
10 years to the terminal value.
Okay. Good. Thank you. I guess that makes sense.
Maybe, I mean, that's what generally I've seen CFAs using 10 years.
There can be multiple models in DCF also, like two-stage or three-stage or whatever.
Yeah. So I've seen Professor Damodaran using 10 years to project for free cash flow growth and then switch over to the terminal one. So I've used 10 year as a period. Okay. But like the discount rate 10%, little more for the company which is ASML, because I feel their debt is rated, and it's a good stable company. It's a less risky company, and generally 8 to 12 is typical. If I give 9%, then you get a higher stock prices, right? Because now discounting it at 9%. But at an overall sense, I think it still makes sense.
So that implied growth, can you say that value that's showing 17.94? How does that change when you change the discount rate?
Yeah. Valuation determined by discount rate, right?
Okay, because my math, I have in my spreadsheet here, based on the forward PE, the implied expected growth rate in the EPS is 54% actually.
So if you talk about forward PE, you brought in the pricing mechanism. This one doesn't look at any pricing. It's all look at your free cash flow and the expected growth. Which I'm putting that I expect the free cash flow to grow at 20%. What should my current valuation if you discount it at 9%? Plain and simple. There is no multiples involved in it, because multiples then is based on what the market is willing to give. This is what the company may be worth.
Got it. Thanks. Yeah.
That's a difference.
18% is the low bar, and my thing is showing 54% as the high bar. So essentially, it's like
54% free cash flow growth.
No, implied growth rate in the EPS is 54%.
EPS is different. Yeah, so we're looking at a free cash flow growth.
Right, which is implied growth. The picture, the number that you're showing, implied growth is the
free cash flow growth.
In free cash flow. Wow.
Yeah.
Okay.
Because the DCF or the reverse DCF is all driven by the cash flow numbers. Anyway, at a high level, I still like this company. So let's, and the other question, are you holding? I own both ASML as well as TSM. So let's look at TSM. Let's first look at an overview. Again, I think the big difference why I have a lot more red boxes here, and then that's why I have to now double dip and say, hey, do I want to own this or not? TSM is a huge capital intensive company because hey, it's when you build a new fab, it is going to cost you 30-40 billion dollars. So it is a capital intensive business. Don't be under any impression that it's like a software related business in which you don't need a lot of capital. Now a lot of software companies are also becoming capital intensive businesses because they're taking building data centers. But even with this huge capital investment, they are still able to maintain some decent margin. Look at these are like Microsoft level margins. Profit margins 40%. These profit margins could beat at any time any great software company profit margins, except Nvidia. I'll give you, because Nvidia is not capital intensive, right? They don't make their own chips. But that's why I still like TSM. If they other thing I like at TSM is they are a little more conservative. If they want to grow faster, they could, but they don't want to invest unless they have a surety that there's going to be demand for it. You should listen to the CC Wei, the CEO, in terms of how conservative they are, and that there could be a downside to it that is forcing Elon Musk maybe to go and build its own terafab because he can't get enough chips from these people. So they've signed up with TSM, Samsung, right? They can't build enough chips, so Elon is gonna put its own fab that could become a competitor. And for TSM, if they decide to go for, we're gonna maybe produce chips for other companies also. But I think right now the terafabs, the thought process being building terafab is for the internal consumption. So I still like, until we see terafab coming in, and it's not easy to build chips.
No, I
You
think
don't
he
figure out.
decided to do a partnership with Intel. I think so. Intel is going to build that fab for them for Tesla now. Is there some?
So Intel will probably build some chips for Tesla, but terafab, they are going to invest and build their own chips also, right? I've not gone into the
Yeah,
detail or not read into in
yeah,
terms
but
of
it will
what.
be like I think same like a same stack, right? Kind of, I guess. Like they will use what Intel has been doing, I guess, right?
Okay.
To use their experience, probably.
Oh, okay.
I
No,
would think
Intel
so.
stock has been on uptrend after the deal announcement. So Intel stock has performed really well, I guess, this week. So it's got a huge look at this huge green candle. Yeah. I have a covered call expiring in May at 55. Hopefully it will come back down. I'll still retain the stock. Otherwise, some portion of will get called away. It's fine. Too much too soon. Building fab is not a joke. Right? It's a huge capital intensive, and it's also TSMC has perfected this process over years, decades of process knowledge. Right? But hey, don't bet against Elon. So I can't bet against Elon. But we'll see. Right? Looking at Intel, uh, man, too many reds. Too many reds. It's right now, investment in Intel is based on a future story of future, right? History is all kind of a crappy. For last 5, 10, 15 years, the historical numbers are crappy, right? So, and that is why it's a very small portion of portfolio because it's based on a future story. US need Intel, plain and simple. So these are the two companies. Any other companies you guys are interested in? We have a Netflix reporting result. We can look at Netflix if you want to, or any other company. Any individual finance stocks. We don't generally talk about finance stocks because I don't own any. I mean, consider Berkshire Hathaway is a financial company, but the real banks, I don't own any banks. It's very difficult to understand their financials.
I'm
How
short some regional banks.
you are short on regional banks.
Yeah.
Is it because we're not gonna get interest rates cuts?
So 3 years ago, the compression of the commercial real estate sector started, and $1.7 trillion of debt was supposed to be kind of like worked out, but it hasn't been. They've been doing extend and pretend, and slowly things are kind of being finalized, but they still hasn't. So you can read in the news over the last several weeks. Well, it's not an instant thing, but they are kind of coming home. So stock price will go down.
Yeah, but they've done better. I mean, at least it's done better than S&P. I'm looking at a KRE, which is regional banks ETF.
Yeah, the ETF is, you're right. It's been volatile. It's gone up and down and come
Oh
down,
yeah,
down.
I think it's trading in this kind of between maybe 70 to 60.
Right.
Wow. It's 2022. Yeah.
So yeah, I guess this is a very small amount position that I have, but it's left over from a couple of years back. But all these banks were crashing. Remember, in the Silicon Valley also we had a couple of.
I have XLF. I think I have short put on XLF. I'm still bullish that eventually financials will, should start to do better with more. Let's say SpaceX comes out, we see a few more companies coming to IPO, some M&A stuff starts to happen, then we should see financials doing better. But yeah, I don't have any individual financial companies.
Excuse me, Vivek.
Yeah.
Talking about SpaceX, should we buy shares of Google or Fidelity since they're principal owners 10%? Or should we wait for Google to go down or something like that?
Wait for SpaceX to become a better business, or I personally would wait for a few quarters to see how SpaceX is doing.
Oh, no, I didn't say that. I said since Google and Fidelity are 10% owners of SpaceX, should we wait for Google and Fidelity to drop a little more?
So if your investment thesis that you want to invest in Google is because of only reason is because they are 10% owner of SpaceX, then wait for SpaceX business to see the results. I own Google. I think last week I showed you my top 15 positions. Google is my second, but biggest position when it comes to individual stocks. Second or third, maybe I think it was second. Someone can correct me. It's on Twitter, so we can go and check right away. But my thesis is not that Google owns 10% of SpaceX, right? So my thesis is a little different because oh come on, I was being interested in Google and I own Google, right? So no, it's number two. Number one is Mercado Libre, and number two individual company is Google for my portfolio. But that has nothing to do with the fact that Google owns 10% of SpaceX.
No, I know that. I realize that, but because the Singaporean billionaire, he owns like the number 2 stock is I think Meta, and the number 3 is Google or the other way around, and I was really surprised that he owns so much Meta.
Meta company it's been a good business. So I'm not surprised that people own Meta. Of course, right? Recent times they had a problem of how are they gonna make money out of these tons of investment that they're doing. But Meta if you're invested in Meta, you had a good week.
Yeah, only a week, because I think as of last 6 months, both Microsoft and Meta are in the same boat. They basically are kind of spenders of the capital which accrues to all these
Yeah.
chip other companies.
But I think so eventually whatever they paid, what billions of dollars or hundreds and millions of dollars to Alexander Wang, Meta released their some new model, which again I've not followed the details of the news, but I think what I heard was that that model has shown to be much better than many of the existing models. So the super intelligence lab, probably is gonna show some outputs now. So Meta get decent business. Yeah, capital intensity is now is increased. But from they still generate after around $40 billion of free cash flow. Okay, if I reduce the stock-based compensation, which is what I want to look at, still $25-30 billion of free cash flow. And now they're saying we are shutting down, some of those fancy projects. So Zuckerberg is becoming an adult now. I think I still like Meta. I'll continue to own it. And it's not that expensive.
It's undervalued right now.
It's not that expensive. Valuation I didn't look at. So let's look at.
Its PEG is only 0.54.
So currently we are looking at an implied growth rate of 14%. Not doesn't seem to be that undervalued if just from a free cash flow growth perspective.
So its trailing PEG is 0.8 and forward PEG is 0.5 according to my spreadsheet.
Yeah, PEG, so multiple side it is compressed. That I'll give it because it's been generally rated with higher multiple. So from a multiple perspective, yes, it is trading at a lower multiple. Do you have a PEG in this one? Nope. We'll find out. Maybe it's an. I have to check what are the data does this provider provides. Oh, I don't have valuation metrics. Income statement, balance sheet, key metrics. Let's see if they have a PEG. LP ratios.
It should be valuation. Yeah, there it is. PE to growth rate. Price to earnings growth ratio.
Price to
earnings. Yeah, that's the one. Yeah. Oh, is it stockanalysis.com? Or what is it called? Financial?
No. No, this is what I'm trying to build. This is on my local machine.
Wow. What program did you use to get the data? Like, you're getting data from somewhere, right?
Yeah. There are service providers. FMP provides the data. So I right now have an integration with FMP. A lot of data is missing. I'm still trying to experiment to figure out which is the best one. Yeah, so this price to earnings, yeah, you're right. PEG is grown down. But this from a multiple perspective, just from valuation, it's not that cheap. Right?
What do you mean by valuation?
Going back to free, when talk valuation is free cash flow.
Okay, so you meant FCF based implied value.
FCF, yeah. Right. I'm looking at last 5 years of CAGR FCF has grown as 14%. Right? Maybe whatever they're investing now will grow FCF a lot more in later on. If that bumps up the terminal growth rate, let's say from 3% to 4%, that's a different story. Right. So if let's say I put 4%, that will tell it's undervalued by like almost 14-15%.
But I guess in this, you're just looking at one kind of data point instead of 10, one being the free cash flow numbers, right? Which are basically deterministic, like exact values. What if there are 10 analysts who have also independently looked at the same thing that you're looking at and come up with implied price and growth estimates, which then become part of what so-called consensus estimates and all. And
Yeah,
that's
yeah.
what
So you can pick up in terms of again, no, no, we can right now. I'm not able to get the free cash flow growth estimates of analysts. If you think that's going to be 20%, put in 20% number.
That's
I
what I'm
don't.
saying. The PE to growth ratio is basically accounting for 20, 30 analysts all tracking Meta.
No, no, but you're not talking about valuation. You're talking about the pricing and the valuation are different things.
No,
A
no.
$20 bill value is $20. Some
Mhm.
analysts could price it at 21, some analysts could price it at 18.
Right. All I'm saying is valuation in the sense of PEG is what's called
PEG
growth
is not a valuation. You brought in a price to
divided by
earnings
growth.
growth. So it's a pricing mechanism. I mean, it took me hard time.
Is valuation compared to the growth, right?
Yes, and I've included growth. I have included growth. You're
So you
talking about
have
pricing compared to
price,
growth.
you have the price impounded there. You're basically backing out from the price an implied growth figure.
Yeah, this is so from a current price,
Right.
it is implying that you need to grow your free cash flow by this percent for
Right.
next 10 years and then grow at 4% terminal rate free cash
Right.
flow growth.
And now let's dissect PE to growth ratio. It also has the current price in there, just like you have current price in your model, right?
And for in the future, it's not looking at the free cash flow growth. Is look
The
what
growth
is it?
estimates are, you're right, the growth estimates are collected from the 50 plus analysts professionally dedicated on a daily basis to pounding their Excel to track Meta, right?
Yeah, but what's the growth is for earnings, not for free cash flow.
Okay, there's a difference. That's true. But
Yeah. So we're talking about different. We can't compare. It's apple to oranges. That's all I'm saying. I'm not saying that they are right or this is right. All I'm looking at is if you're looking for free cash flow perspective, this is what priced in. In terms of free cash flow, growth is currently this. If you don't want to look at free cash flow, you want to look at, hey, there is always a number and the story behind it. You want to look at there's a momentum behind this is, yeah, sure. Then we can look at a earnings multiple. That's why we have multiples also to talk about, right? Uh, this just give me a little grounding on because sometimes I've seen many of the companies that are stock prices have gone to stratosphere, but when I run through these numbers, I'm like, there's a lot of it's coming from multiple expansions, right?
can you
Not
look at
really the
this?
quality that is gonna generate so much of cash flow. So then I have to basically tone down my enthusiasm according. That's the purpose. I'm not saying don't buy this because now this model shows it's fairly valued. This
Can
model
you
only look at
Micron?
cash flow.
Micron with your tool? Can you bring up Micron?
We'll have to pull the data. I don't think I have it. I actually cleaned up the data because I was trying to take some backups and it was just failing. So okay, we'll get to the Micron data.
Yeah, because it seems to be very, very undervalued, and I'm curious what you show.
Was
It's a profitable
in
company.
parallel, I'm just looking at the log to see. We are looking at MU. Yeah, it is bringing in the data. So always take a lot of time first time. Come on. Any other company? So I'll take a note. We got a Micron.
For your tool, because you want profitable companies, right? So Micron is profitable, but others are not.
Yeah, but this is what concerns me, right? Trailing 12 months, I'm looking at a great revenue growth, but only trailing 12 months, and we know why it is because of the shortage of memory chips, right? Prior to that, not that great. Profit margin 23% in last 1 year. great profit margin for a memory-based company, right? But otherwise, it's like not too shabby. I mean, 14% is not nothing to sneeze at. It. I mean, it's above 15%. My stuff will show as green. But I'm looking at Micron. It's not. I mean, it is a capital intensive business. This is what worries me. All the cash flow that they are generating, operating, they are investing everything into capex. In some cases, they're probably taking on debt. And if the future pans out to be as great as what we think, this will all be forgotten. Right? But if it does not, the debt at some point of time might come and bite it. I don't know. How much is the debt? I mean, I've never looked at Micron. So we have a $9.6 billion of cash, $15 billion of debt. Right. So, yeah, so they do have a fair amount of a debt on their balance sheet. And how much of a, okay, we can look at their interest payment, but let's look at valuation side. You want to look at valuation. Currently, we're implying 13% growth in, 8 to 9% growth in free cash flow.
So it's undervalued, right?
Currently, it's implying only 8%. And if we think that it's gonna grow free cash flow at 10%, yes, then it is undervalued. Or if it's a 15%, then it is undervalued.
So if you just go back to screens, it was showing PEG ratio right there, 0.19. Go back once.
That's a PEG ratio.
Believe that? That's way undervalued by my measure. When you look at growth versus expected.
And the large amount of debt they won't have because they have a good enough interest coverage ratio.
Yeah, that's what matters. Basically, it's like Micron has been around for 40 years. I remember back in there was a year when America lost or sent all its DRAM business abroad, and Micron was the only company left in the United States doing this commodity memory thing. And it's been around, so they have a good debt servicing ability.
So I erased all their AI tailwinds now. Now I'm looking at how they performed when there was no ChatGPT. So basically got back and now look at, I mean, they performed decent even without a ChatGPT tailwinds.
How did you remove ChatGPT?
I gone back and now I'm sitting at the end of 2022. So ChatGPT was released in November. The impact didn't start to show up until 2023 or for Micron until 2025. Now I've gone back in a time machine. I'm sitting at 2020, end of 2022. Even in that case, their 1 year growth will be like growth in year 2022. 3 year will be 2022, 2021, 2020. 15 year will basically take me to 2007. They've still done decent. Numbers are not, the numbers are okay. I'll give it to you. I've not looked at Micron because I thought it was okay, all memory and AI tailwind, but this makes me curious. Even without AI tailwind, there seems to be a decent business.
And then getting into more of the high margin HBM, which is high bandwidth memory, as opposed to the DRAM.
How is the competition from SK Hynix and Samsung's on this? I don't understand this.
All three of them are eating it up, like the 3 players, Hynix, Samsung, and Micron. There's so much demand. They're basically booked out for a year.
Okay, so Rajeev is saying Melee. Let's do Melee. And then we got Oracle and Exxon. Let me take a note of this. Memory is cyclical business, but that's what I went back to. And this is what I want to do is go back to 2021 when we had no AI, no ChatGPT, and then see how the companies have performed prior to that. Just take that AI tailwind out. Micron seems to be a decent company. However, there may be companies which put in the numbers and then forget anything after 2022 and only look at a prior to 2022. You realize that they haven't been a great business. It's only because of AI tailwind they have been able to put in some numbers right now. So this is what looking at a Melly. Yeah. So retailer. So understood. And this is why this is not a pass or fail. This is my first pass to see, should I dig deeper into this or not? So revenue growth has been uh, pretty impressive for last 10 years. They've been growing 46%. This is the only company I know which have grown their revenue consistently over 30% quarter over quarter for 29 or 30 quarters, right? But it's a low margin business because it's in a retailing business. So at the end of the day, it's a question of high volume, low margin, and building a moat behind it.
Can we talk about the software stocks which got trounced this week? All the Adobe and Hood and
Adobe future looks great. The past is great. If I run an Adobe, I won't be shocked to see a lot of greens here.
With regards to Melly, do you know why in the past year it seems like the earnings have somewhat flattened? And I kind of posted a link where I was looking at it.
So the Melly, so over the last since I think 2023, they've been gone into a lot of investment mode. They're opening warehouses in Brazil. Number two, they've expanded into new product line, which is a credit card, which is a high volume, low margin business, and that's the business which is growing at a much higher rate as compared to the rest of the business. So I think there's somewhere in after one of those earnings, if you look at my post, I actually did a detailed deep dive into why I'm not concerned about this growth on, why I was not concerned about some of the issues that market was. There is somewhere I gave a 4 reasons of why the margins were lower, and I think market puked on it, but why I was not concerned about that issue. I can't find it right now. But yeah, investment in building infrastructure and moving into credit card business, growing that at much faster rate has caused compression in the margin. As long as you understand that, and number two is as long as their credit card business doesn't result in increase in their NIMAL, net interest margin after losses, doesn't reduce their net interest margin, I'll be still okay with them to increase their credit card business. So they had moved very slowly into credit card. They're basically trained the risk models to make sure that they don't basically offer the credit card to people who can't, who eventually become just defaulter, don't ever pay. And now they are going big after kind of running that for more than a year. Now they're expanding that business as like at a very high rate. This is Q4 2025, right? So somewhere I might have margin compressed, high upfront provision for bad debt. The 90% portfolio has grown 90%, so they increase the provisions. Not that they have actually seen the bad debt, but they have to increase their provisions. It's standard part of any company. Lowering the threshold of free shipping. This is one area where you're seeing competition from Sea Limited, then making a strategic investments to increase their first party sales. A lot of investment in warehouse and all that stuff. Cool.
What about Sea Limited? Is it in a good boat?
Sea Limited again. So Sea Limited is competing against Melli in Brazil, and of course they have a bigger operation on in Southeast Asia. But I like the management of Sea Limited.
But why did it go down so much in the last 2 months?
Yes, let's look at what happened to SC again. They have a investment. They are in investment mode. Right. Okay, let's look at SC.
It's not.
I can only talk about what they did in their recent
So
earnings.
they're not part of the AI kind of being
No.
trounced. Yeah.
No. So Q3, quiz Q.
Well, it peaked at 190 just in October.
Q4.
And
So
it's been halved.
yeah, earnings was beat. Sorry, revenue was beat. Earnings was beat. All businesses are growing. The concern that I had was the cost of revenue. So this is where the margin compression happened, right? In terms of the cost of revenue for Shopee increased by 43%, which was higher than the revenue growth rate. And there was market basically, I think market was worried about how to achieve its 25% GMV growth rate without sacrificing profitability. So during the earnings call, a lot of questions around how you're going to grow, because there is a competition against Baba, there is competition against Mercado Libre, and competition against Coupang. Right. So any new growth was lowering their margin, and market is questioning that. So that was a concern. But I own all other three also. So someone will be winner if it is a. No, my bigger worry is, and I think I did post that as well, is will any of these will win, or whether it's the consumer who will win, right? If everyone is trying to competing against other and will be forced to lower their prices, maybe eventually the consumer will win. And that's why on SE, at least I'm not backing the truck up. I mean, it is down a lot. If you look at Sea Limited, it is down by a lot, but I have to wait and see in this fight, will they win, or will it the consumer that will win? Yeah, look at 100 and it was like close to 180 last October. Now it's correct to almost to $85.
I have to say I bought C Unlimited after hearing you last year. It's
Oh, you didn't. I bought it at first time when it was $35. You should have heard by that point of a time. So my cost basis is still very less. So, but at this point of it, that's what I'm like. Hey, they are all fighting for the same consumer. Is consumer winning, or these companies will win? But I like the management of Sea Limited. Yeah, but it's a tough business because it's in a retail side. Okay, there was a question on Oracle. And I don't own Oracle. I owned Oracle 2022 or something, or maybe 2021, around $45, $50. And then stupid reason to sell, but I wanted to consolidate my brokerage account. I opened account in Robinhood only in 2021 because a lot of folks in this meeting had questions on how happened this. You do this in Robinhood. I had no idea, so I opened an account, and there were very few shares I kept there. And when I was trying to clean up my account, I said, okay, I'll get rid of, sell everything what is in Robinhood, and I sold Oracle. Maybe at 65, 70. I don't even remember. I have to go back and see where it sold. And then I never got back into Oracle. If you really look at an Oracle, I will never forget that 30% jump after that shown their RPO. Yeah, this jump, and what a stupidity it was. And I did tweet about it. I'm like, come on, guys. it's not a confirmed revenue. It's an RPO, and these things could change. Who cares? Market get excited about some of these big numbers. Now it's back to 138. Let's look at a wow. It is back to almost the tariff. What Liberation Day, right? Let's look at the from a number perspective, right? And yeah, this is for all the stuff. I mean, this I don't. I mean, it's nothing much to get excited about Oracle. From a tepid revenue growth, right? And this shows a lot of investment going in. So free cash flow has turned negative. Hopefully all these investments will increase the revenue growth. Then I will get interested in this. But it's I'm not saying it's a bad business, but it's not that great a growing business. One of the great businesses. It's a steady, ready kind of a business. Grow at 5%, 10% growth rate. Cut down your cost, increase your EPS by 15%, return the cash to shareholders in terms of little bit of buybacks and the dividends. Sure. But it's not as, I mean, someday you see the narrative around how the AI would, maybe AI tailwind will make it great, make Oracle great again, MOGA, but I yet to see. Currently, the numbers don't suggest that. But hey, if it is available at much cheaper valuation, then maybe this is a value play. Who knows? So let's look at from valuation perspective. What am I looking at? Okay, forget about free cash flow. So there is valuations won't even come into picture because they moved negative into the free cash flow side. Right? But let's assume that they will grow their free cash flow. How much have they grown in previously? This is Meta, right? Let's bring it Oracle. Free cash flow last 1 year data is this is annual. Free cash flow growth. It's been all over the place. I don't even know what number can I pick up. But for argument's sake, let's say we pick up 5%. Now, I don't know how this model will work with a negative free cash flow starting. I have to figure that out because the free cash flow is negative. Oh, that's why it's not showing you any valuation-based, cash flow-based valuation numbers. Right. Look at the insiders. What are they doing? Sell. What is J? J is okay. We don't know what that is. Oops. Let's sort it date-wise. Award, sell, dispose. Don't see any buys. No buy. What is G? G is gift. Yeah, then none of them are buying any shares. Let's go back and look at okay. Okay, mostly sell, award, one buy in 2022. Okay. Yeah, I'm not right now very enthusiastic about Oracle. Maybe the AI tailwind will grow the revenue, but single-digit revenue growth doesn't excite me. And in the business where you have to invest a lot, your free cash flow is going down, revenue has to grow up for me to get excited about it. Or any other company?
Sorry, Vivek, could you touch on valuation for Melly?
let's go back and look at. So we're looking at. They did $10 billion free cash flow last 12 months. They've grown their free cash flow by 63%. If you just look from free cash flow perspective, let's say I'll give them they do, because right now they're going to invest a lot. Currently, market is assuming that their free cash flow is going to go down by 4% for next 10 years. The current pricing assumes that, like negative 3.95%. That's what the market is assuming. But if you think that they can continue to generate free cash flow from a valuation perspective, and let's say keep it only 4 or 5%, maybe we should check what other retailer free cash flow, free cash flow growths are. If I put a 5%, then yes, it is really undervalued. But market is thinking that you're not going to be able to sustain because of heightened competition. Will not be able to sustain your free cash flow. You will be losing cash flow. You have negative growth for next 10 years. And if we think that's going to be true, and we may have to wait for a few quarters to see that against in the backdrop of competition from Sea Limited, and I think Amazon announced recent some partnership that instead of a growing, if they are losing free cash flow, then we have to change the number. Right now, market is assuming they're going to lose at 4%. Okay. All right. Make sense? Any other question? SanDisk compared to MU. Don't have a comparison, but SanDisk SNDK. Oh, we'll come to SanDisk. So today morning, just for the fun sake, I took Snap. Right, and this is where the quality of business matters. Snap has been around for many years. Right, never made any operating profit. Operating margin have always been negative. It's been only a revenue growth story. This is why I don't get super excited about revenue growth anymore. I used to be when I was like new to the market, and I want to see at some point of a time, will you be able to turn your revenue into something meaningful for me as an investor? I don't see anything on Snap. So if you recall, I sold off my Snap like a few years ago. It's $9, $10, $11, something between, maybe $10 to $12 in between. Because I was tired of waiting for Evan Spiegel to fix the business. And then I'm like, okay, I know what, I'm done with this thing. He's never going to learn his lessons. Two free cash flows. They report free cash flow, but if we back out the stock-based compensation, they would always negative. On top of it, they will continue to okay, I need to change it. This has to be negative. Okay, hold on. Looks like this is picking up the absolute number. Because if you go back and let me look at its detail, they've been diluting the shareholders like hell. Where is share count? Yeah. So share count has been increasing at 3%. Okay, I don't have the diluted number. That's probably even higher. So they've been diluting the shareholders. And eventually, this will show up in the stock price. Right? Eventually, it was a darling. $70 in 2021. I should have sold it then. But at that point of time, I didn't build my own framework. Right? And I think I sold at maybe 12 or something. 2023, somewhere here, right? But now it's sitting at what, $4? Now it's an acquisition target company. Right? Someone will acquire it. Maybe a PE firm might acquire it. Fire Evan Spiegel and all other people. You know, the company has got billions and billions dollars of accumulated losses. And on the other hand, they've enriched the management by issuing almost $10 billion worth of stock. Come on, guys. At some point of a time, you have to just call and say, you know what, I don't want to be associated with this company. Such a horrible business. Or I would say horrible management. Business, there are a lot of bad businesses. But the management has a gumption to keep spending, billions of, oh, this is quarterly. Let's go back to annual. Right? And if you look at a share-based compensation, just add it up. Right? They spent billions of dollars on enriching the management. So I don't want to be associated with this management, even if they move to other company. SNDK. Sorry, we started with SNDK. Okay, I've never pulled the data for SNDK, so we'll have to do for the first time. And GLW is Corning. I think Corning is running higher because of all AI, right? The whole optical networking. Basically, not even networking, but not the optic fiber, but transferring data onto the chip instead of using copper, use optics. Rajiv knows a lot more about it, right? You're part of that industry, AAOI and Corning and all that stuff. Now looking at SanDisk, and this is what, again, I don't get excited about the toning. It's not a great margin business. Storage, right now they're having their days because of revenue growth. Suddenly, did the company spun up or something? Or maybe the service provider doesn't have data? Maybe let's look at here, because they pull up from multiple service provider. SNDK, exit chart view. SNDK. Oh no, it's okay. Well, they don't have any more data than what I have. Okay. 10% revenue growth, 9% revenue growth. And then only 37. Isn't this a very
So
old company?
they used to be acquired. They were acquired by Western Digital and then again spun off as separate company.
Okay. Oh, I
Yeah.
thought I knew that they came out of Western Digital, but I did not
So it was
know that
previously independent. Yeah, it was
it got
independent for a
acquired and
long
then again
time.
spun out.
Yeah.
Oh, okay. That's why we don't have the history. So, but let's look at a Western Digital in similar kind of a business. I mean, we don't have much history, but whatever history we have isn't good. I mean, that doesn't look that promising. But Western Digital is WT, right? You're bringing the tickers that but I cleaned up a lot of my just nuked a lot of data, so I have to go and fetch it. But I haven't followed these Western Digital or SanDisk, so I never looked into it for my own self. TTD, rip or will it come back? Tough choice on TTD. I'm not too bullish or adding to TTD at this point of a time unless I figure out how they're gonna compete against Amazon being DSP. And now with all these AI models, right? You're gonna have them run a campaign and all that stuff. I'm not selling out. I'm just watching, waiting and watching. Western Digital. It's I mean, 70.
Vivek, Western Digital is WDC. This is a different company.
Oh, come on, Walker Dunlop. WDC. You have me pull. I'm like 17%, 15-year CAGR profit margin. Not bad. Well, how did I earlier had an indication saying, hey, this is not a great from a business quality perspective. Okay, so let's get WDC. Okay, I think I just got the data. It's just building in the framework. Okay. All right. Anything else?
How about these ServiceNow and all these, the stocks being
So
affected by
I'll tell you, if I pull ServiceNow numbers, the history will look good. It's all about the future expectations. Right? Market is pricing in that they don't have any future.
So
Yeah,
it's based on
this is more like it. What I would expect from Western Digital, the tailwind is only in last 1 year, right? Huge revenue growth is suddenly like up 50%. Otherwise, they've been decreasing their revenue. I mean, because of the storage prices are just going in one direction, which is down, right? I forgot, but I remember paying in like for 500 MB big hard disk some $50 in 2003. Right? Now you won't even find 500 MB hard disk, right? But in any case, so right now all the tailwind is because of AI. Let me take that out. Sitting in 2023. I mean, I don't know. I don't like this as a business. Let me put it that way. Maybe it'll give you some dividend, and buy back some share, but not much of a growth. It's not a good profit margin business also. So yeah, the stock has been on fire because of the recent demand from AI. But let's see how long they if you want exposure to AI related tickers, look at it. I don't want to add any more exposure to low quality business just because they are part of AI. If I want to add more exposure to AI, I will still add to high quality businesses and not to the low quality businesses. Because once the tailwind goes out, these businesses, low quality businesses, are the first one to get hit. High quality businesses will survive. Right? One of the highest quality business is still NVIDIA. It's not that no one knows about it. Everyone knows about NVIDIA. But look at this. Don't have a single red cell in this. 55% profit margin over last, like if you look at a 15-year CAGR, it's 30%.
Yeah, this has become the cash cow business like Microsoft was for 10 plus years and so on.
Wipe off the AI tailwind. Right? Still, it's a good business without AI tailwind. Good cash flow generating business. So if I were to buy or get more on AI side, I will buy some good businesses. And then I want to buy good business, then I'll see if they're from a valuation perspective, does it make sense or not? But I'm not going to put money in WDC. It may be a speculative play, sure. Go, if you want to do that, go ahead. But if once the AI tailwind goes out and it drops like a rock, then don't complain why did I even, why you got into WDC. Because if it was a speculative play, you should understand it.
Vivek, I
Yes.
think I asked you this last week. But how did we get in another memory storage problem like we had 5 years ago, 4 years ago, 5 years ago?
No, which memory storage problem we had 5 years ago?
Now it's sorry, now it's not CPUs. It seems to be a SanDisk and Western
Oh,
Digital.
no, it's a Marvel. Now it's a memory problem. So earlier we had a chip problem after COVID. Now we are like chips means your processing chips problem. Now we have a memory chips problem from Marvell and SK Hynix, and I think yeah, these are the two big players.
Well,
sorry,
like
Micron, not Marvel, Micron.
so we could understand why the pandemic we have a CPU issue, but now it's because of all these memory centers. That's why we have a
Oh
memory.
yeah, memory, because all this data center. I mean, if to run your AI workload, you basically want to, your overall context window size has been increasing, and so you need to store that much amount of data, more and more data in memory to do the processing, and hence the need for these all high bandwidth memories, right? So it's all driven because of this tailwind from AI.
Thank you.
Otherwise the business in itself it's become a commodity business. That's why you're going back and looking at not MU, but I'm talking about, let's say, these SanDisk, etc. Not good profit margins in it. They got last 1 year they got a good revenue growth story. Otherwise the revenue was also going down. So I'm not interested in that one. We are already like 12, 20. I didn't even realize. And we didn't get into one chart which I definitely wanted to show was this one, right? Anthropic wanted for first degree murder. Team is down 64%. HubSpot team is basically Atlassian's collaborative, like most famous tool is Jira, and then there Confluence, not Confluent. That's another company. HubSpot, customer management tool, DocuSign, Unity, Figma. Figma was what Adobe wanted to buy Figma at $20 billion. Now they can buy it at $9 billion.
And now they don't have money.
Now, in this list, somewhere Adobe will also be there. So, they can't buy another two dying business doesn't create a great combination anyway. GitLab, Workday, Intuit, Zscaler, MongoDB, ServiceNow, Snowflake, BRZE. Which is this one?
Is it time to throw in the towel on all these names like Snow and in whatever Workday? Or should one hope for a rebound? And
Elasticsearch, some Guidewire, Freshworks. Let me just go through the list. Salesforce, AppFolio. This is DocuSign. What was that? Oh, this is Doximity. The list continues. We got Adobe. I think the Precode is a construction software. SAP, Viva Systems for pharma company. Roblox, JFrog, Shopify, TYL. I have no idea. So BRZE, TYL. Anyone knows what these two companies are? I've never looked at these two companies. Oracle, Toast, which is a restaurant payment, and now they're expanding into restaurant management software. Palantir, I think 15% came out from this week. It was down 15% this week. Autodesk, Checkpoint Software, Okta. What is DT? Is it Dynatrace? Datadog, PTC. Again, I don't know PTC. Take-Two Interactive, Microsoft, must be Roper Technologies. Let's look. What is DT, PTC, And third one, which one I did not know? BRZE. What are these? DT. Okay, Dynatrace. Okay, then I know. PTC. I have no idea what. It's a company operating in Americas, Europe, Asia Pacific, manage the product life cycle. I've never. It's a $15 billion, even after this drawdown, it's still a $16 billion company.
So Vivek, any idea why this is? I mean, I understand it is because of Mythos, but I mean, what? It's another model, maybe cybersecurity
No,
wise.
it's not all because of Mythos. It's all because of Anthropic is going to disrupt because now it will enable so many of companies to build these softwares at a much cheaper price that some of these companies will start to lose their what do you call pricing power. Like some of you, like, hey, I use Claude to generate a tax return for me. Why would you pay into $839?
Oh, makes sense.
Right. That's the question. It now in some cases will it be able to replace CrowdStrike? Like now with the release of or let's say Zscaler or some of these Palo Alto networks, some truth will be, you know, you will still not vibe code these things because we want a liability protection. But some of the stuff people are questioning is when Claude can figure out after the release of when they relay the information on Mythos. First of all, let me ask you, does everyone know about what happened this week on the Mythos or Mythos, whatever you call it?
Yeah. Yeah.
So you are in this area. So the whole idea was, so Claude came up with a new product called Mythos, and they didn't release it for public because they realized that that software is so good that it went and found security vulnerabilities that have been in our browsers and in our operating systems for last 30-40 years. No humans have yet figured it out. No researchers, no security researchers, no AppSec guys have figured it out, those vulnerabilities, which their product figured it out. So they did not want to release it to the public because the model is so strong that nefarious actors can use this for bad stuff. So they informed White House, they informed US administration saying, hey, these are the things that we are finding it. We are not going to release it to public, but they release this information to and the models, etc., to Google and the Microsoft, CrowdStrike, and some consortium of these cybersecurity companies, saying, guys, we are effed up.
Yeah.
There are so many security holes that we are not even aware of. This is what my model has found. And bigger question is, if Anthropic model has found it, who is to say that some model in China hasn't figured it out yet? Maybe they also figured it out. Maybe they are building, you know, now they know where the security holes are, and that's what then suddenly got not, of course, Wall Street as well as the White House concerned. And the White House called a meeting of all the CEOs of big banks to come and talk to them on Friday. And I think except Jamie Dimon, all CEOs of big banks had attended it, like Bank of America, you know, Citigroup and all that. And we both had Scott Bessent, Treasury Secretary, as well as Jerome Powell. Generally, you won't see Jerome Powell mingling with the administration because they want to stay independent. But this issue is so big that if the threat actors if an American company's model can find it, what if any other Chinese company model have found it? What if other nations who are not friendly to US, now we keep adding names to that list, their models have figured it out and they may attack us And first thing they did was to call all the CEOs and say, you gotta secure your stuff because if the financial system get attacked, we are toast. So, and that's why like CrowdStrike, Palo Alto, all the stocks went down because now the market is questioning is if the model can figure this out, what the heck you guys have been doing, right? So, but I think at the end of the day, maybe all these companies will start to use powerful models and become more efficient, and rather than, but in a short term, a market is so much concerned about it. Right? Saying you guys are supposed to be expert in it, right? And you guys don't know, whereas Claude has figured it out. So that's the whole story this week happened around why there was a meeting in White House and the bank people were meeting it. Because we are concerned. If we have figured it out, let's not assume that others haven't. It's very much possible that team in China has already figured this out, that we have vulnerabilities that have not been so far, nobody knew it, that it is existing in our system for 30 years. So it has already gone into all our tech stack everywhere. So that's a concern. And the way that Claude is so powerful, and I don't see the names of other LMs, right? Then they will be able to make a lot of these softwares. The more and more entrepreneurs will come into the market and say, oh, you are Intuit, you are at TurboTax, which allow people to pay taxes. I can build it using Claude because Claude is doing a great job of telling you tax and figuring out. Right? I can build it. So you'll see there are 10 competitors, basically vying for Intuit, or pick anything else. Team, a Jira tracking system and a discussion or a wiki like Confluence. Creating a ticket or Jira tracking system will not be a big stuff anymore now. And if I don't want to pay big team license because hey, only I'm using one portion of it, which many times is the case in enterprise software, you only are using a portion of the software, but you have to pay for the whole big bulky software. I don't have to. Maybe I'll have my software developer code that portion for me because it's become much easier to develop things and code stuff. And that is causing a concern in all these companies. Like, guys, will you ever be able, will you have your pricing power in future or not? If a customer can say, you're not giving me 25% discount or 50% discount, okay, leave it. I don't want to renew it. Or grudgingly, I'll renew this time, but then I'll have someone, a senior developer working with 10 cloud agents to create a replica for you. Right? That's a concern. So interesting times, as well as scary times, I would say. Very
Vivek, fun part I just gave in Anthropic. Tell me about Mythos. It's not able to recognize. It says, what is Mythos?
Yeah, they don't want it in public. Okay. So somebody, I saw a tweet. I think maybe it is here. This was one, right? Accidentally got leaked. Otherwise, you and I, we should have known about Mythos. It was only supposed to be within the companies and within the US administration.
Yeah, because apparently whilst the engineer dealing with it, he gave it a task. It wasn't even supposed to have internet access. And it gave it a task and it figured out how to get access to the internet. So the engineer got an email from the model whilst he was on a sandwich lunch break, apparently, that it managed to get internet access without when it was not supposed to have it. And it also posted on the internet that it had managed to do this. So yeah, good luck.
So we have a rogue agents who are going outside what they were supposed to do and doing the shit stuff.
Might be the overachiever sort. Yeah.
Another part of this argument, to take a pessimistic view, is people think maybe it's also to marketing play. so that they can charge more for a special tier because they have costing issues. Yeah.
Well, these guys could charge more. Right now, if whole of Congress is part of it, it's probably not just marketing.
Yeah. So I think now the Congress, like the administration got involved. So the question, it better be, as scary as what they have told about it. Otherwise, it's not going to look good. When it comes from a marketing perspective, I mean, their revenue grew what? Again, grew 100% in like 3 months. And I am seriously considering, once this month is over, to move on to the max, which is like 5 times more. It's $100, not 200, which is good. I'm seriously considering, taking the Claude's $100 plan, because I already spent $50 on buying additional stuff. So which is like $70 I've already spent, and then I have to worry about my token being consumed and all that. $100 will be no brainer for me, and I'm not the only one. Right. So yeah.
One of my favorite AI outcomes so far have been I've finally stopped seeing the Grammarly ads on my YouTube feed because AI does the job better.
Oh yeah. I mean, now who wants Grammarly anymore?
Yeah.
Yeah, it's they all will be using these things in the back end. It could be Claude or it could be Codex, any of these things, right? But many of those companies are now, their business model have completely been destroyed. And one company which comes to my mind whose business model, like, I'm not saying, let's say, Zscaler business model will be destroyed, etc., right? Because they have a lot of other domain knowledges. It's not just that you've discovered, you stop the fall, you have to do recovery and whatnot. So I think some of these companies will recover, some of these companies may not. But there's one company that will never recover and is already dead. It was the company stock went through the roof during COVID. But then the ChatGPT came out and we didn't even go to the cloud, and that business model they got toasted. Anyone can take a guess?
Duolingo.
No, Chegg. James got it right. Yeah, Chegg. But look at a Chegg. Let's go to CHG.
You mean internet-based tutoring?
Oh, this is not even tutoring. This was the students will go and find answers for their homework assignment.
Oh, there was another one called Course Hero startup.
Coursera?
No, Course Hero. There was a
Course Hero. Okay.
Homework Hero or something like that. Right here in Palo Alto, it was started as a startup.
So look at this growth, because everyone was like, hey, students wants to not write their own assignments, but they'll go to Chegg and get an assignment. They've been growing nicely. And this was the peak when everyone was at home. So their option. And they grew like 60%. And boom, they released ChatGPT. And now it's been like down. Like this year is like down 40%. Revenue is down 40%. And eventually it will show up in their pricing. If you look at their chart, let's go to 5-year. It's down 99% in 5 years. There's nothing left. I mean, this business model is not going to come back. You're not going to go to any other online service to say, hey, can you solve this question for me? And they'll be able, and basically pay money to them. You just ask ChatGPT. You just ask Gemini. A lot of them are good in this stuff. This is not going to come back. The bigger question that I have is, which one of these will become Chegg? Which one of these will survive? And frankly, except a few, let's say, I don't know much. I can't visualize like which one will be there or will be not. And that is why I am not picking any specific companies. I think some of the domain knowledge specific companies might be able to survive, or if they are dealing if they're a system of record, they may be able to survive. Otherwise, I have no idea which one will be able to survive later on.
The ones which are just connecting various numbers and text.
They're all gone.
like Intuit, for example, they are decimated. Or even if you are creating this so-called workflow in, say,
No,
ServiceNow.
so companies like Intuit, I'm a little different because Intuit, the cost of making a mistake is very high. So some companies may want to offload the work still to Intuit, just as a CYA, right? I don't want to take that liability on me. That may be in some of the other regulated industries, let's say medical, I may not want to take that chance. Like cybersecurity, I would not want to code, even though Claude is great, I don't want to code it and then as a CISO, company still get hacked and then my neck is on the line. I need someone else's neck to choke. So some of the, again, that's my feeling, that some of the functional areas where the cost of mistake is high, you still want some sort of insurance, some sort of protection, someone else's neck to choke. You might still go with the vendors. But the vendors will still face a lot of tough competition. There will be 10 other companies saying, I want to be Intuit. I can make a product as great as Intuit. But some of them will still survive because if I'm a payroll provider or if I'm an HR manager, HR head of a company, I don't want to do and taxes or deduct taxes and all that or run your payroll based on a software that has been coded by me or by my software developer because the liability lies completely on me. But I get it that Intuit or some other company may survive, but they'll have a very tough competition. But there are a lot of other stuff, right? Hey, creating a ticketing system for managing my internal workflow. Yeah, I don't have much of a liability. Yeah, why would I need team if I can create a Jira tracking system? So I have a big concern on team or let's say HubSpot, etc. Right? It's your own company's, like you're not gonna get sued by your employee because your customer relationship data, you lost a sale because your CRM data wasn't that great or didn't give you the right information. Not gonna get sued by it. But if your taxes go wrong, you get sued. If your data get breached, you get sued or you have a reputational issue. Your regulators will come behind you. Or maybe in terms of medical data, you have an issue. So some of them will still be around with a lot of a tough competition. But some of the other stuff like Rajiv mentioning, they just connect the data from disparate sources, show you in one way, tough. That's the problem.
So why is DoorDash down in the last 6 months? I mean,
Is it more of panic
That
selling
maybe
is what I feel like.
Huh?
I mean, it's more of panic selling is what I feel because even we haven't seen how exactly is Mythos or yeah, they are saying some 40 plus companies are working on that, but I'm still not clear with that. And in fact, with especially with this AI, right? My perception is these things, yeah, even Opus, you can get to, if you want to build a successful product, you can get to 0 to maybe 60 70 faster, but the last 30% is like either it's not, it becomes so unusable, you cannot debug and a lot of issues are there. I'm not sure how they have solved those things.
our market is thinking that we will get through that. In another 4-5 years, we will
I
figure it
guess
out.
things will stabilize and kind of like very solid contenders to Intuit TurboTax will emerge. I mean, I personally have thought of building something to replace my annual expense on TurboTax because all it's doing is fetching forms and connecting the numbers inside, and that's it. I used to personally prepare the tax return before TurboTax also, right? What's
Yeah, I've done it
different?
by hand. I've
Exactly.
done by
The
hand.
point is like all these fancy things were kind of thrust upon us in the last 10 years. When HubSpot was born, I was shocked to see what the hell is it doing? There's nothing great about it. I don't know. I was short HubSpot for a long time.
So, and that's look. If I'm looking at service now, I mean, code revenue growth, but other concern that we may have is going ahead in future. Will they be able to, grow at the same rate and command the same premium? Past of Adobe is great. Past of ServiceNow has been great. The market is concerned about all the future stuff. And let's say, for example, right now, I am seriously thinking of maybe another month or 2 months. I may not need stock analysis subscription anymore. Because hey, I built this stuff using for myself.
But you need this raw data source, right?
That's fine, but and I'm able to do a lot more. I mean, I've not shown you some of the other stuff which is around own portfolio, my own portfolio management stuff. I'm still working on it. And today, if I were to do this, like some of the functionalities don't even exist in any brokerage form. It is impossible to do. Stock analysis only give me the data for the financial data, which I will need for managing my portfolio also, which now I'm building along with it. So I'm like, dude, yeah, I'll pay to that data service provider. So if you are a system of record, if you are the provider of data, and if I can get, it is more difficult, still figure out, if I can get Claude to directly hit SEC website and refine the raw data in the format that I want, then I won't even need the data service provider. So Claude did give me an option, but I wasn't ready enough to do all the data cleansing and in the format that I want, normalized one. So I chose a data provider which does it. But once I have more time, I'll directly go to SEC website. Like I go for 13F. I don't go for any other intermediary website anymore.
Can you do that same for corporations? So you can go to the S&P 500, each corporation's IR website and get their numbers and essentially replace FactSet. Can you do that?
Yeah. So today because I don't have, I just wanted to do other stuff. So I said, hey, let me first put the building blocks ready for me, and for now let me pay to the data service provider. But there is no reason that I need to pay for other data service provider. I could get directly information from SEC. Other aspects of SEC will rate limit you and all that stuff. That's okay. But I mean, that's what I've done for 13F analysis is I don't go for any other, other data service provider. This you directly hit SEC and you basically get all the data. Right. So
I have
this stuff I wanted to do for many, ever since I started tracking 13Fs 2 or 3 years ago. Right. Such a Herculean task it used to be if I were to do the way I was doing. It helped me to build this. If I had a 13F subscription, first thing is that goes out. Sorry, I had to cut you off, but continue.
I was saying, see, a lot of these things which we're building a software, at the end, why we have a software as a middle layer? Like, why can't you just talk to model and get all those things? You are still writing a software. You are not using directly a model.
No, I'm not directly using model.
Yeah,
I use a model to create a software.
Yeah, what is the reason? Like,
I don't want to depend on Claude changes something breaks, etc. And first of all, I don't even know that how to do that or go at that way.
So the thought process around that, it's basically the model it's a probabilistic model.
Correct.
It's not deterministic.
It is not deterministic.
So that's a more crux of the problem. No one will be able to hand off anything which has a revenue implication or a monetization implication. Those questions will never go to the model directly. We still have a loop where we ask model to write a code. We do as a qualifier to say if it is working or not working, because we put our judgment on that. And then we say, okay, that is a deterministic model which we generated is a software. That has been happening for last 30 years. Like every software you see has a dependency from the OS layer to here. There is a full determinism baked into it. So if something goes wrong in Linux, everything get affected. So that is the pillar block of software. If you try to replace with the modeling, like the LLM model, that is not there. There is no single block which can say this is 100% true, and then you can build on top of it. It's always 99.999%.
Yeah, because that's how
Even
all these LLMs are built, right? These are all probabilistic.
yeah. So that's where my take is, yes, people will use the model, people will go to models to see their work get done. But eventually, let's say if tomorrow I tell you, like, you have this whole as you're saying, stock analysis. If tomorrow you ask a feature to Claude and it make a mistake, will you not cross-check that mistake caused you to take a action on buying something or selling something? You will always go and cross-check, like, this doesn't looks good because it make a mistake. Like, yes, today only you said it's supposed to be red, not green, for one of the stock.
Oh yeah,
But you
because
caught it.
on my, I mean, that's not Claude mistake, because the Claude is not giving me anything. I asked Claude to do this or build a software like that. But
Yeah, but
that's
it's
why
a
I
software
was saying,
building mistake. It's a building mistake of software. Like, if you are handing off responsibility right now, that responsibility is being taken care by Intuit or other companies. As long as you are okay to pay for that service till the point you say need a reliability
oh
on the
yeah, I
services
think,
where you're.
yeah.
So
So
Nitish, what point are you trying to make?
no, I think the
So
same
my
point that we were discussing, Nitesh, is that as
Okay.
long as you have a concern of getting sued, basically liability, you would want to offload it and have someone else's neck available to choke. Right? In this case, or let's say if you're building something that is only related to your own data, and no one else is related, only the impacted party is only your own company, and then why would you want to pay if you think, guys, this is 99% accurate and I don't have to pay Salesforce or XYZ gazillion of dollars and using only 10% of their system that they built, if I can just have it done myself.
And TurboTax makes mistakes. You can never assume that the agent, somebody said, you cannot put the liability on the agent, like a CPA is an agent or TurboTax is an agent. The liability is always on the principal. Look up this thing called agent principal relationship concept.
But yeah, I mean, they will have,
You give a bunch of crap data to your CPA and say, oh, it's his fault. No.
no. So even or if you're a system of record, you will still survive. But I having tough time to assume that all these companies will be around, and I don't know which one will be around and which one will not be. That's the toughest part.
The way I'm seeing it, it will happen. See, it's not just that people are getting these LLM. All these companies also getting these LLM
Yeah.
and reduce the cost of building software. So the prices will go down eventually, and people will come back to these only as a solution.
So people will come back to the solutions, may not be the same companies. I think that's the debate we are having, is these companies may face a lot of competition from other upcoming startups, because the cost of developing the software is dropping. So you might have 10 other companies springing up as a competitor for Team or for HubSpot, because now a lot of if you use an entrepreneur, you want to build a competitor to HubSpot, is easier to build.
It'll be more intelligent software than the current.
Yeah, whatever, right? But the idea is that it'll be, and that's also positive side of the AI is while it is disrupting a lot of the current businesses, is gonna give rise to a lot more entrepreneurs who have great ideas, but they were never able to move ahead with the ideas because they were it was too prohibitive in terms of even trying to experiment with those ideas. Now, if we were to experiment, I can start with, if you're a product manager and you want to experiment with different, product ideas or design ideas, you're not spending time of your UI designer, of your technical consultants, precious hours. You're gonna ask Claude to do it. And if you're also entrepreneur, you can move ahead and create a lot more business. So I'm positive from that aspect, is there will be a lot more businesses will be created because the cost of creating, especially at the software side, is coming down. So the competition for the incumbents will start to increase. Eventually, we will still need software companies, but it may not be HubSpot or may not be Team, could be something else, which is much better. So
I'll ask you another
But
question.
what is the bottom line, right? I mean, these companies will survive or
I don't know which one will survive. So again, the companies where the areas where the cost of doing a mistake is high, that companies will still be around for longer than the other companies, right? Or there is a proprietary data available. If you are holding a system of record, you will still be around. But if you have none of these, you are not a system of record. You are in a business in which making mistake is okay, right? If you're operating on someone, you need 99.6 sigma, right? 6 nines accuracy. You're not gonna go and say 95% accuracy. So those will survive. But company like customer relationship management may not. Company like Asana, which allows you to create tasks, you can build Asana in half an hour. So many of these companies who were selling, hey, Microsoft project is much bigger a tool, way more complicated, will build Asana, were selling to small and medium businesses. Now the small and medium businesses could say, maybe I can just do it for myself. I don't have such a complicated workflow. All I need is a task tracking stuff. Why do I need to pay to Asana? Or I'm just taking an example of Asana. That those companies will have a tough time, or they have a tough competition.
No, won't Asana, I mean, as Nitesh suggested, right? Even Asana also will have LLM. So won't they be able to do better on Asana because they're already maybe at 80% of the product?
Yeah, but Asana, but there are a lot of competitors who will also have access to LLMs. And remember, incumbents always move a little slower than the ones which are coming up with the new ideas. New entrepreneurs are always full of energy. They have the latest thoughts and the latest, what is the best, and they want to build from scratch at that level. Now the cost of building has come down. Asana has got a lot of legacy stuff.
So Vivek, on the same thought, you do review startups on the other panels. Like now, do you see that there's no moat in any of the startups because whatever they're building can be redone by next company in 6 months?
So I will tell you, a lot of startups come up as a wrapper on some current existing broken business models, right? Put an AI wrapper on it. So I see a lot of startups will be related to that. So which I will just discount. Its current business model is broken. Putting AI is not going to fix the business model. There are a lot of startups where I have a question on, hey, you are using this LLM, but what is the mode or what is the proprietary knowledge or information or data or skills, something you have which other competitor can't just use that mode. In some cases, like my previous meeting, we met up with the folks from ex-engineers from SpaceX and Tesla. And I think I met them like last August, September sometime. That was the first time they pitched in. And I really liked it because they use LLM. So the moat doesn't come from using LLM. The moat comes from the proprietary knowledge around the process of building precision manufacturing, which they have learned during their time in Tesla and SpaceX. Right? And I think the recent one, they came back again and they showed, that the growth that they have seen in their business. But if you don't have that proprietary knowledge, if you only thing you have is, I use this LLM and jumble up and create a song, and there are companies who were like that in terms of depending on your mood, it will play different type of songs, etc. There's no mode in that. And the mode in that case will be how you're going to distribute it. Right? But
The way I see before AI disruption, the startups were evaluated in two ways. One is the idea and then the execution, because execution takes a lot of effort. Like if the problem is hard, the execution has a lot more contribution on the valuation of the company. Now that execution part is now trimmed down to very minimal. Like everyone can do that execution
no,
because
no. So hold on a
I'm
minute.
talking about the software company only, not the
No. Even for the software company, most of the founders make a mistake that the building software company is creating software. Distribution is going to be the king. How you gonna sell? Who are you gonna sell? Because the creating software is become much easier. Is the other stuff which is going to be tough, because creating software has now become easier, but now you have to focus on the distribution side. That's where people, a lot of new founders will stumble upon in terms of, okay, I'm gonna sell it, I'm gonna make money out of it.
Yeah, marketing and distribution. Yes. Even marketing also, I think.
Yeah, distributions go, and that is why I'm still bullish on companies like Apple, etc., because they have a huge distribution channel. 2 billion devices. Software creation cost has come down, but software creation is just one part of running a business.
Will there be a disruption in the marketing as well as distribution? Do you see?
When it says so, marketing is already been disrupted, right? In terms of creating your marketing campaign, etc. A lot of companies are in fact using LLMs. That's one reason why Trade Desk is facing the issue that it is facing. Is a lot of companies also, for creating campaigns and all that stuff. If I'm not I don't have a sophisticated requirement, I can also have LLM or build something that LLM will help me to do it. So from anything that was related, that you were working on a software to get an output, that's gonna get that's is gonna have a challenge.
I just take it one example, like compared to maybe a year ago,
Mm-hmm.
a lot of people don't take GitHub star as a metrics. Now that become a primary metrics in a lot of cases of the software industry, like how quickly you can rise the number of stars on your GitHub.
Yeah.
And you have a good example of Claudebot. That guy was basically bought by the Anthropics because of that reason.
Peter Steinberger.
Yeah. So there is a switch happening. Like now our people used to look at other modes. Now people are just saying, okay, you have a proof, show it, and the distribution channel of software now become on GitHubs.
Yeah.
That is where I'm seeing the other dimensions are now opening up.
It's an exciting time. All I can say, it's an exciting time. I'm hoping to see a lot more companies with great ideas being able to at least experiment and create. Many of them will fail, and it's okay to fail. 90% of projects should fail because not everyone can succeed. And when you have such a low cost of experimentation, people will experiment more, and so hence there will be more failures. So, but yes, super exciting times, guys. Sorry, we are way off our agenda. I don't even know where we are. It's already 1 p.m. Let me stop sharing.
Vivek, can I bring something else up?
Yeah, bring it on. Hold on. One sec. Let me open up the breakout rooms because, hey, some of you want to talk about something else. You can get together in a breakout room. Let me also stop recording.